past us. The firms do not want to invest, they don't want to borrow, and they don't want to hire. And so just by announcing COVID zero is over, pulling back some of them easing measures, this is all great. It makes the lives of citizens happier.
That was Leland Miller, the China Beige Book International CEO, live from New York City. Equity shaping up as follows on the S&P. We're down about 0.4%. 4 days of losses into Wednesday. Will we make it day 5? Euro dollar just about positive, 104.95. Tom, yields unchanged at 353.86 on a 10-year. Crude, keep coming back to crude. We've got China incrementally reopening, easing restrictions, I think is the best way of putting it. And we've got crude rolling over the last couple of days, Tom, 74 handle and basically negative for 22.
I'll agree with that. The China's part of the story here, but I'd also note that yuan has come in and now has found some stability near 7 yuan, 6.98 yuan per dollar. And John, I don't think we can look at the financial aspects of China right now. They are so overtaken by this pandemic, this virus, that the normal analysis we do just doesn't work.
I think Leland would also suggest, Tom, there's other things going on beyond COVID zero.
Yeah, thank you.
Big property issues as well. The data's not being great. If you just remove COVID zero, yes, you get this short-term burst, and maybe you get this cyclical story, positive cyclical story kick back in, but certainly there's still some challenges there, TK. Some big challenges at that.
Yeah, our conceit here is we have a knowledge of Hong Kong and Shanghai and Beijing is distant. That is not the case for Thomas Mackenzie. He is in London, and Tom Mackenzie joins us this morning with many years on the Beijing watch. I was thunderstruck, Tom Mackenzie, the first time I got off the airplane in Beijing. It's not the same. It doesn't smell the same. The air is different. The people are different. It's foreign. What is the gap now between what we perceive of China and COVID and the distance to the capital, Beijing?
Well, Tom, I think with today's announcement, that gap has narrowed to a degree. John was talking about the incremental changes, and that's absolutely right. But the announcement today from the Politburo really is that pivot on COVID zero. We've heard the rumors, we've heard the speculation, and indeed we have seen those incremental easing measures in the last few days and weeks. And some of those have been walked back again as officials have panicked about outbreaks in their jurisdictions. That changes from today, I think. But to your point, the consequential parts going forward are to what extent this is implemented on the ground, because this is going to be challenging. This is a population that doesn't have high levels of immunity. The healthcare system is challenged. So how they actually exit from COVID zero is what we should be watching in the weeks and months ahead.
The model, maybe not from 1947, but certainly from Deng, is that the mayors of these big cities have power. Discuss the power nexus now between the cities and their mayors. The city-state of Shanghai is one example. And for that matter, the rural power as well with Beijing. Is there a dialogue or is it imbalanced?
More of that power, of course, is concentrated in Xi Jinping's hands, and we just saw that with the latest party congress. One of the reasons why officials now are talking about setting themselves a 5% GDP target for next year, which many would say is ambitious, is precisely to incentivize those local officials to move away from COVID zero and accelerate growth, to put an emphasis on growth, because there is a concern amongst those officials of pushback, reprimands, losing their jobs, sometimes worse, if they don't follow the line of Beijing. That's the reluctance to move away from COVID zero, because they haven't had that clarity until now. So setting themselves that 5% GDP target for 2023, if that does come to pass, the argument would be amongst those officials pushing for that is you incentivize those officials in the villages, in the towns, and the districts to move away from COVID zero and focus on growth.
In order for people to really understand how serious China is about moving away from zero COVID, you have to understand the vaccination process, how far they've gotten in expediting some of the shots in arms, particularly in the older population. How much has that effort gotten underway and created something of a buffer heading into winter?
This is a really, really crucial point. I know we discussed it before, but again today, a new line out on the need to accelerate vaccination. So for the context, the over 80s in China, of course, the most vulnerable population, just 50% have had their booster shots. Around 60 to 65% have had double vaccinations. That pales into comparison to the likes of Japan, the US, European nations. So there is a massive catch-up that needs to be happening around vaccinating that older, more vulnerable population. And question marks as to why they haven't mandated it, those questions will continue. they've had 3 years to do this. They haven't acted quickly enough, would be the argument for many. And certainly failing to approve the vaccines of Pfizer and Moderna has also set them back as well. So we'll see how consequential this vaccine push is in terms of getting more shots in arms and also the building out of fever clinics around the healthcare system to ensure that they're ready for an uptick in infections and hospitalizations that many now predict.
Feeding some of the belief that China really is beginning to more fully open up is Xi Jinping getting out there and meeting with foreign leaders now in Saudi Arabia. Is there some signal to take from there that China is trying to secure enough crude at a decent price, trying to supply itself ahead of a reopening, or is this just basically a reordering of world orders and really a convenience on both sides to show a power of their united strength against the U.S.?
You know, it was interesting. I was speaking to a trader here in London about a week ago. He said, watch for this meeting between President Xi and the Saudis. There may be an agreement around using the yuan instead of the dollar as part of these transactions on oil. It doesn't look like we're getting there, but that is the interest of some on trading desks here in London around this meeting. It is a push by Xi Jinping to have a more multipolar world, to push back on what they see as Western US-led hegemony. And to some extent, there is a success here from Beijing, solidifying this relationship with the Saudis at a time, of course, when we know that Riyadh and Washington have deep frictions that continue, of course, with the Biden administration. So there's a play here. It's complicated. China is a major, of course, user of commodities. It is far from being self-sufficient when it comes to energy. It needs those resources from the Saudis, but is deeper than just a transaction around oil.
Tom, you've got a Beijing view versus Endacur and based in Hong Kong as well. I'm curious of your view of the potential of what Western banks will do in 2023. Are they going to stay as a generalization in Hong Kong with outposts in Beijing and Shanghai, or do you subscribe to the movement to Singapore?
That's a fascinating question and absolutely a theme and a trend we have to watch. I mean, when I was there a little over a year ago, we were still at a place where you spoke to the investment banks of Wall Street, of the UK and Europe, and they said they were pushing to have greater ownership of their operations. There was a fight for talent. They were trying to add headcount, trying to build their footprint in mainland China. That, of course, has been reversed to some extent, and you've seen that with the big names on Wall Street, European lenders as well. The shift to Hong Kong, yes, you speak to the Standard Charters and HSBCs, they say we are still investing for the long term. We're going to remain committed to Hong Kong to get that exposure to a reopened Chinese market. Does the shift away from Singapore end next year? I would say that was doubtful, but is a theme to watch.
Hey, Tom, thank you. Great work as always, sir. Tom McKenzie out of London. Do we need to drop COVID zero, just that phrase now? I think we do. It's not just COVID zero or we're open, wide open, and there's no restrictions. This is about China changing its tolerance around this virus. So now I'll give you a couple of examples of some of the restrictions that still exist. So close contacts can quarantine at home now for 5 days. Well, there's another way of phrasing that. Close contacts still need to quarantine at home for 5 days. I would go further. Lockdowns in high-risk areas will be lifted if there are no new cases for 5 consecutive days. Well, there will still be lockdowns in high-risk areas. That's the issue at play for me here, Lisa. I think it's easy to say, yes, no more COVID zero, but that doesn't mean we're wide open in China. We've just shifted the tolerance around this virus.
If that policy were implemented in the United States, in New York, that would be considered a lockdown.
Without a doubt.
That would be considered a very controversial aspect that would close schools, that would end up disrupting workplaces, that would make it very difficult to live a normal life. To your point, that's not a full reopening, but is it the beginning of something that looks more like that could potentially be expedited? We're not seeing it in the market. We're not seeing that faith.
Well, that's how markets think about these things, Tom. It's about the change. And ultimately the end game. So you kind of flick through the pages and get to the end chapter and you're not interested in the stuff in between. But
Did you ever do that? I always read the last
went to the
page first.
conclusion. You think I read a book? Anyway.
I had a cat in college called Cliff Notes.
I can't remember the last fictional story I read.
Really? I love them, but I always read the back page first, even then, and then I read the middle stuff. But I get it's very stressful to not know.
Do fiction.
Can I just very quickly here, I do want to mention it is the 81st anniversary of something which framed my childhood, which was Pearl Harbor. And what's different this year, and it started in March, is I've been there, John. I've smelled the oil above the Arizona. The oil, quarts a day, still leaking out, 81 years on from the Arizona. And finally, from an environmental standpoint, they're saying of this small harbor, what are we going to do? It's like ESG creeping in on Pearl Harbor. This is under debate.
It's been going on for that long.
81 years, the oil still leaks out. You're in this very emotional monument above the boat, the ship.
I didn't know that, Tom.
And the oil comes up. You're standing there smelling it.
That's
and
insane.
Finally, for the entire harbor, the Navy's under some Pentagon push to clean it up.
How many years? 81?
81 years.
Wow. Coming up next on This Market, Alessia de Longis of Invesco. Looking forward to that. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Inflation is too high, and I will contend that this current inflation battle is not one-off.
The likelihood of a soft landing is quite low.
The idea that we're going to have a soft landing means that so much of the data would be historically unique.
No one is placing big bets yet that we'll see this miraculous second half rally, but certainly that's the sentiment.
The only thing that we can be sure about is that this is going to be a really choppy ride.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bramo on World Cup.
It's almost, it's a little deeper than me.
Seriously.
It's a value add compared to me.
It is tearing the U.S. team apart.
Vintage, absolute vintage. Honestly.
Like 3 days ago, she's an expert on American football. Irish Jersey, our bond guy's looking at the ceiling going, when does this end?
Turns around to me and says, what was your problem with the team? They were cute.
Hold on a second. No, you are mischaracterizing what you said. You were saying that the Spanish team was passing, and they just passed too much. They don't have a game after that. And I was saying, well, that seems to be the U.S.'s problem as well. They couldn't shoot. And you know what John said? John said, but the U.S. can't pass like that, so they don't even have that. And I was saying they're a sweet team. They're actually like really. I like our team.
You're speaking truth here, Bramo.
Oh yeah, true speaker.
Get us back on the rails. Do something.
Equities right now negative 0.4% from New York City this morning. Good morning. Good morning. We have had warning after warning on Wall Street in the last 24 hours. It has been overwhelming. We've heard from David Solomon at Goldman Sachs, who Tom said bumpy ride ahead.
Come on,
we
the
heard from
economist
Jamie
David
Dimon at
Solomon.
JP
Get
Morgan.
Hatzius on. Let's
Looking ahead to 2023, saying maybe mild to hard recession, and that's what we're waiting for. But at the moment, we don't see it in the data. The ISM this week has been decent. Payrolls on Friday was great. Which one is it? Where are we right now, and where are we heading?
Well, I'm in the camp of optimism here, but I'm looking on the screen, equities, bonds, currencies, commodities, and there's all this microanalysis on a jumble. Lisa had a great phrase for it this Wednesday. The bottom line is it's pricing recession. That's the summary. Oil, bonds, real yield, Bloomberg Financial Conditions Index. It's all pricing in this likelihood of recession. I can't get there.
If you want two recession prints, 2's 10s on the yield curve, negative 80-something basis points, most inverted yield
Negative
curve
82.
we've seen since the early 1980s. You want another one? The fact that crude is negative on the year for 2022, if you're just tuning in, I think this is just staggering, phenomenal. After the year that we've had, Lisa, to see crude negative for the year.
I don't get it. And people are trying to say, well, you just aren't understanding recession. You aren't understanding what's being priced into the market. But as you've pointed out, John, it's not being priced into the energy stocks. So in the stock market is not seeing the same picture that the oil futures market is seeing. Who's right? A lot of people say that oil stocks perhaps have to come down. Why not the other way? Why don't they have to go, why don't you see oil go up, given the fact that you are seeing, I mean, have you guys flown anywhere? Do you see how packed those airplanes are? Do you see how much traffic there is?
Can't get home.
I mean, I'm just saying.
Yeah, my answer on flying is that you can get there, but you can't get home. I thought Francisco Blanche had the line of the day, if not the line of the week, and he called it spring or whatever. You know, the answer is he's looking for a rapid rebound in these depressed Brent and WTI prices.
Chris Verone said it. Look at what's happening with the miners in London, BHP, Rio through November.
Yeah.
Big gains. Look at what's happening with iron ore. He's looking to the China reopening story. Maybe some demand, Lisa, kicking back in.
Again, we saw progress in that, and it's not being priced into the market. It's not really making a dent on oil prices. Why didn't oil prices pop when we got a loosening in certain restrictions in China? Was it just because they thought that it was just a beginning? Was it people just basically, we've seen this story before?
Got more easing of restrictions this morning, and futures are negative on the S&P. Let's whip through it. We're down a third of 1% on the S&P 500. 4 days of losses on the equity market coming into Wednesday. Does it become 5 elsewhere in the bond market? Yields are higher by about a basis point, 354. Your euro stronger by 0.25%, 104.93. And there's crude, Tom. Low 70s, 74 on WTI.
Yeah, 74, 73 too earlier. It's a grim chart. And again, to have Edward Morris and Francisco Blanche with us back to back was a real joy. And they had some nuances. There's some real differences. I think Ed on a micro basis is really looking for demand to come in, and demand hasn't come in. EIA out, I believe it was yesterday, with not a grim view. I think that's overplaying it, but a real caution about what global demand does.
Lisa, WTI 74, Brent crude 79.
It will be a story that we will continue to track. Also today we are watching 10 a.m. To me, the Bank of Canada rate decision has been one of the most underplayed events all year. It has set the tone. It has been out front of other central banks. Do they downshift to 25 basis points in their 7th consecutive rate hiking cycle, given how hard yields have gone and how much, particularly their housing market, has started to roll over? We will get that decision at 10:30 a.m. We get the EIA crude oil inventory report. We've been talking about the conundrum. Why have oil prices come down so much? Are inventories starting to build a sign of a lack of demand, or are they actually declining, showing what we've seen all year, which is actually inventories are still pretty tight. Again, this is what Francisco Blanche was saying, that actually you could see a real pop-up in oil prices because of that lack of resilience, that lack of buffer. And at 3 p.m., we get October U.S. consumer credit data on the margins. This will actually really determine how much spending power consumers have. We have seen a decline in disposable incomes, particularly on the lower income brackets. Can people borrow? Can they just charge it and not pay it back for a while? Is that what we see, an ongoing increase in the credit card outstandings? And to me, John, that's been one of the main question marks underpinning this recovery, and it ties back to the oil story. People have money to spend, and that is the reason why you are seeing a lot of these economic data points come in stronger than expected.
Is it being depleted slowly? And Lisa, thanks for that, because it's a key question. I think we got a hint from that from Brian Moynihan of Bank of America, Tom, just a hint that maybe we're starting to see that cushion be depleted. Megan Green wrote in the Financial Times earlier this month and said something similar.
Yeah, I think that there's a lot of framework going on here, but my answer is, and we'll have some outlooks today as we do always in December, there's way, you had it best, John. I quoted you like 4 times in the 9 o'clock hour yesterday. You nailed it. You said it's cute. It's cute December.
Getting too cute for 23.
Strategy game. I just
way too cute.
Totally disagree with this approach.
Jim Bianco of Bianco Research was on top of that as well.
What did he say?
He said we're too cute for 23.
I wasn't listening. I'm sorry.
Anytime.
It was on your other property.
Well, you know, you're sort of like 10 minutes with me and 10 minutes out.
Yeah, you know.
Put this in a headline. An outlook that's different to all the other outlooks. Alessio De Longis of Invesco joins us right now. Alessio, increased portfolio risk. We're overweight equities. So let's just get straight to it. Alessio, why are you guys going overweight equities?
Look, a recession is not a question of if, it's a question of when. And we do think that a recession will come at some point, maybe in late 2023. The point is that between now and then, markets still experience very large fluctuations, both equity markets and credit markets. And when you look at the type of events that are likely to occur, the type of news flow between now and then, there is plenty of reasons to expect that between the variable lags of monetary policy and that recession, the news flow will be supportive of cyclical assets at the end of this year, so now December and Q1 of next year. Look at the news out of China. Is it a full reopening? No. But is it the right direction of travel? Yes. When you look at equities or risky credit, the attractiveness for a cyclical rebound here is, to us, there is some element there. When you look at the Fed that is looking to signal a pause in the tightening cycle, while those recessionary prints are not coming yet, that is likely to bring good news to the market. You guys talked about oil coming down. That is likely to bring down inflation. So if you find yourself with, over the next 3 months, no recessionary prints in the economy yet, and high credit spreads, falling inflation, falling oil prices, and a Fed that signals a pause, I wouldn't necessarily want to be in front of that, waiting for that deterioration in the economy.
Let's see, on a global basis, but almost a transatlantic basis, if we have disinflation, yet not down to 2%, let's agree on that, we still have nominal GDP. Is that enough to support the market away from the gloom, and that we've got better nominal GDP where revenues at least survive?
That is a great point, Tom, and it's something that I know you have emphasized in the past, and I think with huge merits. We always focus on real GDP, when the reality is that we should focus on nominal earnings and hence nominal GDP. Now, inflation is likely to come down, so nominal GDP will also come down. But the reason why, despite all the doom that we have seen, earnings have held up and equities have held up is primarily because stocks are an inflation hedge, some better than others. But having a healthy rise of inflation, which certainly isn't this one, but if inflation comes down to 3-4% and the real GDP growth holds up, that is not a terrible environment for equities and is certainly a good environment for risky credit.
Alessio, how much is this basically a bet that consensus is wrong, that we're not going to get the recession in the first half, that it'll get pushed out, and that you'll actually see more strength for longer, and you don't want to miss that? Is this basically pushing against what everyone's saying, which is a bad first half and a good second half, and saying it could be the opposite?
I think that's a very good summary. Look, throughout 2022, we were in the camp that the recession risk were well above 50%. It didn't materialize. Our modeling methodologies told us that something was changing and was not delivering, and we are now at an inflection point. How long will that last? It's hard to say. It's not the beginning of a new cycle. We are going to get a recession, but I think it's exactly your point. We've been waiting for the second half of 2022. Now we're waiting for the first half of 2023. What if it's later than that? And I think that's exactly the dynamic here. We are experiencing a double dip soft patch, and this tango between the Fed, between monetary policy and the economy is where this tension is. And at this moment, I think the recession call should be pushed further out.
Very quickly here, Alessio DeLongis and Jonathan Farrow with us here today. We've got to talk about how Italy changes to rejoin the World Cup mix. It's the first time they missed, John, since 1958.
We missed the last one, too.
There was a huge Swiss one. Okay, I didn't know that, but the answer is you two are watching this. How does a country, how does a team restructure themselves to get to 2026?
I've got to be honest, Tom, it's kind of odd because the team was pretty decent. Just won the European Championships.
Yeah.
Missed 2 stupid penalties in qualifying.
And they had ties that killed them.
Yeah, it was kind of odd. It was ridiculous. I still think the talent's there. And I think
Alessio, what do you think?
I think John is right. We were still celebrating the Euro 2020 win, and we forgot to pay attention and qualify next time. But it's a sad miss, 2 World Cups in a row.
Your Italian World Cup coverage.
That was it. That was the extent of it. 30 seconds. I don't think we want to do any longer than that. Alessio, before you run, sir, I wanted to squeeze one in. Just be hyper-specific for us. Broad, yes, overweight equities. Get specific for me. Give me a call for next year. Where do you want to take that risk specifically?
Emerging markets. Emerging markets will perform developed markets, especially in the first half of the year, and we like value and small and mid caps.
Alessio, thank you for leaving us with that. Yeah, EM, Tom.
Weak dollar presumption, the break of this strong dollar
story,
path.
Sure.
You know, that's the call on EM if you believe in it.
Coming up, Brent Schutte, we'll ask him about it, the CIO at Northwestern Mutual Wealth Management.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Incumbent Democratic U.S. Senator Raphael Warnock has won re-election in the Georgia runoff. Warnock defeated Republican Herschel Walker with a little more than 51% of the vote. Walker had been handpicked by former President Trump. Warnock's victory allows Democrats to hold a real majority in the Senate with 51 seats. 2 of Donald Trump's companies have been convicted in a criminal tax fraud trial in New York. They were found guilty of engaging in a scheme that allowed executives to evade taxes on company-paid perks for more than a decade. The former president wasn't charged, but prosecutors told the jury he knew exactly what was going on. In China, it's the major shift from the COVID-0 policy. Today, Beijing eased a range of restrictions aimed at preventing transmission of the virus. They included allowing some people to quarantine at home instead of in centralized camps. Plus, authorities have scrapped virus tests to enter most public venues. China's government has been under pressure to change its approach. In Germany today, more than 3,000 law enforcement officials conducted raids aimed at breaking up what authorities called a coup attempt. According to prosecutors, they detained 25 people linked to a far-right terrorist group that wants to overthrow the government. It's called the biggest ever raid targeting right-wing extremists in Germany. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023 we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
American manufacturing is back, folks. American manufacturing is back. Apple had to buy all the advanced chips from overseas. Now they're going to bring more of their supply chain here home. The United States is better positioned than any other nation to lead the world economy in the years ahead if we keep our focus.
This is going to be absolutely fascinating. That was the President of the United States yesterday in Phoenix, Arizona. TK, the beginning of something big, you think?
My number one phrase I love to say is I stand corrected, and I stand corrected on the idea of manufacturing in America. I thought some of the conversations we had yesterday show the import of this, even if it's out a long time.
Bringing it back on shore. Nearshoring is another phrase you hear a lot of now. Mexico could be the winner there.
You get that from McKinsey? Yeah.
Is it a McKinsey phrase?
I don't know.
Clearly things are changing, Tom, in a material way.
Things are changing. It's the scale of it. It's the billions of it. But what I think it really says is the success of some of these American geographies that can actually execute this. Could you see a $4 billion semiconductor plant and pick your 20-mile region outside New York City? I don't think so.
Ed Ludlow yesterday caught up with him about Apple, and he used this phrase, de-risking the supply chain. Kept saying it, de-risking the supply chain. And people, when they think about de-risking the supply chain, they're thinking about taking China out of the supply chain. You just wonder how much more of this we're going to see, Tom, in the years to come, and maybe even decades.
There it is, and the president with a splash yesterday, and of course it was noted he went to Arizona instead of Atlanta, where there was a very important election with a result. Our Joseph Matthew joins us right now. So, Joe, I got to ask you about Sound On yesterday. You talked to the guy that counts the votes as well. What did you learn from the Secretary of State of Georgia just before we heard that Mr. Warnock won?
Well, it's interesting you ask that. They were just in the process of counting when I spoke with him, and Brad Raffensperger, the Secretary of State, told us on Bloomberg Radio that it was likely the end of the line for runoff elections here in Georgia. This is important. We've talked about this. Georgia is not the only state that holds runoffs, but it has roots in Jim Crow, going back to the 1960s, put in place here in Georgia to suppress the black vote. Here we are in 2022 with two black nominees fighting against each other for a United States Senate seat. And a lot of questions about why this is still in place now. That's a conversation that'll be had in the General Assembly here in Georgia.
In your travels there, what have you learned about early voting? Early voting of the first Tuesday of November, early voting of this runoff. What's new?
Yep. It made the difference. And what's new is Republicans are on board, I think, now this morning, looking back at the last couple of weeks in which early voting was discouraged by some, including Donald Trump, who handpicked and endorsed Herschel Walker. You cannot win elections like this when you rely on same-day turnout. That was a big part of the story here. Raphael Warnock went into Election Day with a huge lead. It turned out to be insurmountable with nearly 2 million people voting early. You add those who turned out yesterday, another record vote. He won the suburbs. We told you that's where we would be looking. Those northern suburbs of Atlanta chose Raphael Warnock over the Trump-endorsed candidate, and that's where we stand this morning.
Joe, how much is this really a repudiation of Donald Trump's leadership over the Republican Party? And I say this as we hear the talking points out of the Republican Party become, there are lots of potential candidates. It's important to have a robust field. Nobody's willing to come out, or not very many Republicans are willing to come out and say Donald Trump should not run.
Well, we're hearing more of those people come out this morning. Not so much that he shouldn't run. Anyone can run for president, but he may not get very far. We'll be curious to see how that looks in the new year, assuming Joe Biden does, in fact, announce his run for president. But look, Republicans are angry this morning. They see a missed opportunity here in a candidate that never could quite get the job done here, and an overhang by Donald Trump that, look, in Georgia is a big deal. Donald Trump had a very corrosive relationship with the Republican Party here in this state, and it played out last night. Even though he didn't show up with Herschel Walker, his fingerprints were all over this campaign here. You can look at this a couple of different ways. Republicans are also wondering, what if there was a different candidate? This was still a pretty close race. They're within 100,000 votes. There were times when Herschel Walker was ahead in the count last night. If this had been a different candidate, knowing Republicans won every other statewide race in Georgia, we could be having a very different conversation today.
Hey, Joe, wonderful to catch up as always. Joe Matthew there from Georgia. You spent much time in Georgia, Tom? Love it down there.
I have not. I've spent a little bit of time
Get some
there.
barbecue down in Georgia.
Yeah, I went deep into Georgia. I made it to the Four Seasons
Oh, that's
in
how deep
Atlanta.
you went.
That's how deep I went to Georgia.
Great. That's the extent of your tour.
I got to Nashville a lot, but I just didn't get souther, as they say. Emery Horton with us as well, our Bloomberg Washington correspondent, joining us this morning. What are the ramifications, Anne-Marie, up on Capitol Hill this morning after one more vote for the Democrats in the Senate?
Well, this is actually huge for the Democrats. I mean, this was, again, as I said yesterday, it wasn't a need to have, it was a nice to have. But this quote, this fact from 538 stood out to me this morning. It's the first time since 1934 that no incumbent senator from the president's party lost re-election. So if you look at these midterms overall for 2022, this was a huge win for President Biden, especially when you had the lead up to it, thinking that it was going to be a red wave, it was going to be a referendum on the Biden administration. I would say that more so than Warnock last night, I honestly think this was a huge victory for Joe Biden.
If former President Trump does not run again, will current President Biden run again? We have known that he has been reluctant to say he won't run again, particularly because he believes that he is the only person who could win again versus the former President Trump.
Listen, I can't get into the hypotheticals with President Biden if President Trump runs. But what we do know now is that the former president said that he is going to run, right? And if that is how the playing field is at the moment, then I do think you will see Biden step in. And already Ron Klain said that. But Lisa, you also made a very good point yesterday, which was the fact that Biden, even if he decides in the very end he's not going to run, he cannot say that. He has a legislative agenda. He wants to get through the next 2 years. He wants to try to work with Republicans. We kind of see that already happening with the defense spending bill, and that legislation text hit the wires last night. He cannot say he's not going to run, right? So even if he plans on not doing it, he's coming out and doing it. But he has said almost to him in the press, he just wants to talk to his family. Ron Klain said it. He will be running. If President Trump backs out, then we have to take another look at it.
Meanwhile, we're now past the midterm elections. We have a sense of what the shakeout will be. Oil prices are at the lowest. Gasoline prices are at the lowest level going back to early this year. Is it time? And I keep asking this because this is what a lot of people are wondering, for the U.S. to step in and start buying crude. Is this time to start moving away from some of the policies that led to the outcome that they wanted, which was lower gasoline prices and perhaps trying to reduce the cost of living?
Well, we're certainly closer to the U.S. wanting to do that now than we were, say, a few months ago. But I think there's just still too many unknowns. And you still have WTI trading above $70 a barrel. I think when it gets closer to 60, that's when you could see the U.S. have some real impetus to want to go out and fill up the SPR. But the unknowns are huge. We need to find out what's going on, number one, with demand in China in terms of COVID-0. Potentially this week's meeting with Xi Jinping and Mohammed bin Salman could shed some light on that. We also have a huge geopolitical risk that can change prices in a matter of moments. And that's not just Russia's war in Ukraine, but it's also issues going on and potentially in Iran, a regime that's digging in its heels as it has protests continuing. There are a number of unknowns, and I think for this administration to want to go out and buy oil, it has to be closer to 60 than 70.
AMH, great work as always. Coverage from DC on the crude market as well. Just a note, equities rolling over just a little bit. We're down 0.7 on the S&P, Lisa. Just a bit softer in the last 10 minutes or so.
After a lot of the pretty dire projections that we heard yesterday from the bank CEOs talking about a downturn, haven't been the best prognosticators. I have to say, Jamie Dimon was talking about 5% Treasury yields going back about 5 years, and he was right. I mean, I guess it sort of depends on when. We could still see it. I mean,
do you know how to wind up, Tom? You talk about bank CEOs and economic outlook.
Evidently.
Drives me insane.
It's great.
Rick Wagoner, General Motors, one of the first CEOs I talked to at Camp Bloomberg, Duke Economics. He can talk about economics. He's got cred to do that. He gave me a blurb for his book. I think.
But Tom, in all fairness, aren't some of them? I think Brian Moynihan at Bank of America is very good at just referring back to the research department of the bank.
Oh yeah, Brian.
He'll always talk about his
they're
chief
all different.
economist.
Bill Winters over at Standard Charter, I think, has a great view as well. But just don't get me going. Do we ask Jan Hatzius about headcount out in Salt Lake City? I don't think so.
You suggested we should.
It's a little different. Jan Hatzius isn't going to try to be the CEO.
I think we want to know how they're preparing their business for the year ahead.
Yeah.
And if they're anticipating more business and need to staff for that, or less and need to cut back.
I want to talk to Solomon about Marcus. You know, what are you going to do with Marcus?
I'm aware.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer today on Bloomberg.
Equities rolling over just a little bit, 2 hours away from the opening bow. Good morning to you. Wednesday morning, equities down across the board here on the S&P 500. Negative on the NASDAQ, slightly negative as well. Your S&P shaping up as follows. If we can get it on the screen for you, we're going to do that. We're not.
It's the S&P
We're
now.
not-
If it
we
was
don't
the
fancy it.
Dow, they'd put it on the screen.
There we go. What took so long? The
They
Nasdaq
were looking at the Dow.
down about 1%. The S&P down 0.7%. Is that what they're doing?
They're in the control room. They're like, let's see what the market's really doing. They're looking at the Dow. Felix Salmon out with a great note for Axios, just
Tell me about it.
how foolish the Dow is now, how antiquated it is.
Mike McKee sent me that email yesterday.
Yeah,
I'm
thank
pleased
you, Mike, for
Felix and Axios
But
are caught up.
Felix actually, is got some major credit here, and it's the off. I wonder if they're going to make changes in the index to try to equilibrate.
Tom, you know what, Tom? I don't know why they
S&P.
don't. Let's say they stop price weighting the index, right? And let's say they start market cap weighting the index
Adjusting
and just
whatever they
sort of
do.
modernize
Yeah,
the index. I wonder how much more money would attract. Look, my problem with the Dow, and we've talked about this so many times.
I know the journal's talking.
It's not about whether I think it's going to be up or down or whether it outperforms the S&P. It's the construction of it and the fact that given the last 20 years and this massive shift over the last decade specifically towards passive investing, there's just not that much money indexed to the Dow in the same way it is to the S&P.
It is cultural, but the gap has gotten wider in the last odd year.
I get it. The heritage of it in America is if you want to know where the market is, you want to take the temperature of things, you want to know where the Dow is. But the way I describe it, Tom, is it's like asking for the weather for a town that people don't live in anymore. It kind of doesn't make sense to me.
Where are we going to be in 20 years on this? I think we're going to be more towards your thoughts.
Maybe. Clearly things are shifting, Tom, but I'm with you. It wouldn't be difficult to update this and change it, and then I think it has real relevance. 30 companies that are a cross-section of the American economy that aren't just big tech names. You get some industrials in the mix as well. I think it makes sense. I think that's good. That's great.
Yeah, I don't know. Let's go.
I'm not doing any more boards because I don't think any boards are coming.
It's made up of individual names, and Lisa's glancing at individual names. What are we glancing at today?
What do we got, Brahma?
It's an odd week, odd equity.
I'm looking at Apple, and I don't know if you saw these stories about one of its suppliers, Murata, basically saying that it's not going to be a supply side issue. It's a demand side issue. This is an issue with perhaps not seeing people buy as many iPhones, and that's really going to be the main issue. That those shares down 1.5%. Toll Brothers shares are up just a little bit, which is not more notable in terms of the scale of move. It's only up 0.2%. But this is a home builder, a luxury home builder. It's amazing to see any gains on home builders given some of the dire prognostications. But they came out with a forecast that was better than expected, and that to me was notable.
To radio, and I'm seeing this come up on TV. I still don't know what Carvana is. What is Carvana besides they make stupid ads? What is Carvana?
It's an online car dealer.
Used cars, Tom.
Used cars.
Used cars. But the issue is that there are other used car dealers, and they also have moved online, and those shares are down 19%, almost 20% in the pre-market trading. But there's been a lot of internecine fighting with some of the creditors.
Okay, well, there we are, and we're going to see what we've got here. We may have Damien Sassower coming up here on this odd emerging market ballet that we have in the last 3 days or so with weak dollar. Right now, with an incredibly important terse report. Victor York joins us now, Global Head of Credit Strategy at BNP Paribas. And Victor, thank you that you don't mince words. You talk about dispersion, downgrades, defaults. Is it feasible we could have a Bloomberg Total Return Bond Index 2 years in a row with price down?
It doesn't happen often, but it does happen. For credit in 2000, 2003, you had almost 3 years of negative excess returns, and 14, 15, something similar happened. So, yeah, it's absolutely possible. Rare, but not impossible.
Oh, I look at the not impossible, Victor, and it comes down to your really terse language. Let's go to downgrades right now. Are the rating agencies behind the risk that's out there now?
I suspect so. There's a lot of enthusiasm for credit at the moment because, Fed seems to be tilting and, fundamentals seems to be fine. But we've had a lot of rate hikes already. And, and what's also happening is that corporates this year have been using up a lot of the liquidity buffers they built during COVID. So they've gone from effectively a lot of liquidity to not much liquidity at all. And so what's going to happen as we go into 23 is you start refinancing a lot of debt, and that way you start building in higher interest expense, and that way you start putting negative pressure on interest coverage ratios, and suddenly you're going to have a fundamental environment that the rating agencies are not going to like as much, and that's when the downgrades start to happen.
Right now, the consensus seems to be, Victor, that the next year really is going to be a year of investment-grade credit. You're going to see the deterioration in riskier credit in leveraged loans. But if you hold on and you hang on and you watch benchmark rates come in, just simply because we do start to get some sort of downturn scenario, investment grade will be a sweet spot. How do you disagree, or do you basically agree with that consensus right now?
I think investment grade should outperform, the lower rated parts of the credit market. But I mean, let's remember, right? So the enthusiasm here comes from the fact that suddenly you got yields back in, investment grade credit, and spreads too, by the way. And, that's also obviously great for investors. It's not so great for corporate borrowers. So the investor's yield is the corporate's cost of funding, and that's gone up a lot. And, normally what happens is that first you get a bit of rates risk, and then you move on to a bit of ratings risk. And that transition, I think we still have ahead of us. If you run the numbers, and put a bit of downward pressure on those interest coverage ratios, and then on top of that, you start adding a bit of margin compression, and so you get a bit of EBITDA slowdown, and suddenly leverage starts to go higher as well. You are going to look at a fairly substantial amount of downgrades. We think, about 100 billion or so of BBB rated U.S. corporates can lose their rating and go non-investment grade. I don't think that's in the price. I actually think that's the blind spot right now, and where I think people can still be surprised.
When you talk about surprise, there's a question about when it becomes a systemic risk. And we were speaking with Amy Silverman yesterday of RBC Capital. And she said she's very concerned about the leveraged loan market as potentially being a node of systemic risk, of some sort of more significant disruption. Do you see anything fundamentally that could drive that?
I'm not sure I would call it systemic risk, but I would call it a canary in the coal mine, if you like. The leveraged loan market is probably the only market where you could argue there was sort of a more meaningful deterioration in underwriting standards over the last few years. And if you look at the lower rated part of the single B space, we think more than half those companies can end up next year with an interest rate coverage of less than 1. So that's basically the zombie definition. And that means that you end up with a large number of companies unable to meet their current debt payments with their incomes at a time when the Fed is doing QT, and we're essentially going to ration credit a bit.
Victor, we got Damian Sassower coming up, our main axe on emerging markets. And right now we've clearly got a dollar tendency flat to weaker. We've got the idea again percolating that equities internationally in EM will do better than good. Tell us about the opportunity or risk in emerging market debt. Is that a place that it's so beat up, so cheap, you've got to own it? Or is it still a minefield?
It's not so beaten up that it's a home run, but you're right. It tends to do well when the dollar sells off. You can debate whether that's going to happen. It's not necessarily our view immediately, because U.S. slowdowns also tend to create a bit of safe haven status around the dollar. But it's got a few things going for it. One is obviously the dollar. The other one is China reopening. There is no part of the liquid part of the credit space that benefits as much from China reopening as emerging markets. So those things probably suggest that EM can outperform developed market credit in the months ahead.
We heard the same thing from Alessio De Longis 40 minutes ago. Victor, this was great. Victor Hjort there of BNP Paribas. Just to get you up to speed on the markets, we are down 0.7% on the S&P. It is interesting to see the equity market roll over, and the dollar's not stronger. In fact, the dollar's weaker. Euro dollar 105.20 against the euro at least. Euro dollar positive here, Lisa, 0.5%.
And this came after some better than expected GDP data out of the Eurozone as well. So again, you've been asking how much is a dollar story and how much is the other side of the trade. And you are seeing euro strength here, which at 105.18 is notable to me.
Is this an artificial reality compared to what we're going to see on inflation in what, John, 6 days, whatever it is? And
Tuesday.
And we could go down like we're going down now. OMG, it keeps us occupied. And then boom, we go the other way.
Would you like a sneak peek of next week? Just a survey for CPI.
Yeah.
So month over month, this is our survey relative to the previous month. Our median estimate is 0.3%. Previous month, 0.4. That's headline. Core, 0.3 versus 0.3. If you want the headline year over year, we're looking for a drop from 7.7 to 7.3. Headline. Core year over year. Looking for a drop from 6.3 to 6.1. And of course, that comes 24 hours away from the Fed decision.
I'm just sort of worn out by the volatility now, and that 1 week we're like, OMG, we're going down, and the next week, like Friday last week, was it? Or Thursday last week?
I'm with you. What a difference a rally makes. It completely changes the way everyone talks about a market, and then a sell-off. All of a sudden, everyone's super negative. It's hard landing. This is why the old phrase, and we've heard it a million times, is that sentiment doesn't shape price. Price shapes sentiment, right?
I think that that's fair. I just want to go back to the Apple story because Morgan Stanley just cut their expectations for their output and the sales of iPhones because of the recent warning from the supplier. This goes to the question that you're just talking about, which is how resilient is the consumer? That has been the defining feature between whether things are heating up or slowing down, as you put it yesterday.
Very quickly, a landmark today. Boeing makes the last 747 seat 60J was my favorite seat. This is for Atlas Air, the cargo developers worldwide, John, 52 years on. That's it for the single best engineering invention of our life.
You're emotional about this.
It's a huge deal, huge deal. It is the queen of the skies.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, Democratic Senator Raphael Warnock has turned back Republican Herschel Walker in Georgia's runoff election. Warnock was reelected with a little more than 51% of the vote. His victory will give Democrats a 51-49 edge in the Senate, making it easier to legislate. Walker had been backed by former President Trump. China is retreating from wide-ranging COVID-0 policy that is blamed for damaging the economy. Beijing will now allow some people to quarantine at home instead of at centralized camps. It's also scrapping virus tests to enter public venues. COVID-0 pushed down consumer and business confidence and left people stuck in a cycle of outbreaks and lockdowns. Saudi Arabia is rolling out the red carpet for Xi Jinping today. The Chinese leader will visit the kingdom for several days and will take part in a regional summit with Arab leaders. According to the Saudi news agency, Xi is promising agreements worth some $30 billion. The trip comes 2 months after the Saudis snubbed President Biden's pleas for oil. The CEO of Euronext says there's a new normal in Europe. Stefan Bujna tells Bloomberg that firms are now listing outside London because the UK's financial capital has been declining since Brexit.
Brexit was a big decision and big decision entails big consequences. London used to be the largest financial center of the European Union, and everybody liked it. Today, London is the largest financial center of the United Kingdom. What is happening is that companies that under other circumstances would have considered being listed in London are listed outside of London.
Several weeks ago, Paris overtook London as Europe's largest stock market. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities. those retirement savings products favored by risk-adverse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Point when it becomes really painful is going to be below 65. We still have, and you just remarked on it, the U.S. government having indicated it might start buying oil if WTI falls below 70. And I think that's the first test.
Not at 65 yet, but we're getting closer. That was Ed Morse of Citi just yesterday. Crude, year to date, is negative on the year, as of earlier this morning. Just absolutely ridiculous. Here's a snapshot of the price action for you right now. Slightly positive on the session on WTI, $74.37, up by a little more than 1/10%. Yields a bit higher by a single basis point, 354 on a 10-year. And this is interesting, just breaking down that correlation between stronger dollar and risk appetite, Tom. Equities are down 0.7%. Dollar's weaker, not stronger. Euro dollar here, 1 of 5.21, positive 0.5%.
There's an oddity to it, to say the least. And, idiosyncratic Turkish lira weakens out as it has quietly, and that's a separate story. But the big story to me, John, is we're addicted to these big figure moves on strong dollar. What we saw in shock for 6 months, maybe it's over.
Is China underpinning that move? Is that what's happening here?
Well, and again, with yuan under 7, we have a strong renminbi, 6.98 on yuan. This is a joy. Joining us right now, Damian Sassower with Bloomberg Intelligence, Chief Emerging Markets Topologist. We're thrilled he could join us today. Credit Suisse years ago had a famous chart with little flutters up. For those on radio, I'm curving my hand up, of where everybody got wrong.
Connection lost.
Called the Fed. You can make the equivalent chart in your world where finally dollar weaker, EM up. We're there right now once again. Is this time for real?
You know, my mom worked at Credit Suisse back in the day. You know, she worked for Larry Fink back there, First Boston.
Really?
Yes,
Lawrence Fink. Were they doing ESG
mortgage-backed securities? They weren't doing EM then, but they were, so look, I don't want to go off topic.
No, that's surveillance. We'd never want to do that.
I want to stick to the base. I mean, look, it's going to be a tale of two halves. You guys have been saying it all week long, right? It's the first half, which is going to be an absolute mess. And if the U.S. does go into recession, you expect spreads to go wider and equities to decline. And that's that second half when China's supposed to reopen. And for emerging markets, I think that's really what you have to hang your hat on. I personally remain a little suspect on it, but if you look at dollar yuan, certainly that's what's pushing the broad dollar index a little bit weaker here, but I remain suspect on euro. I mean, I have to say it's the yuan and the euro. That's what's going to affect EM currencies writ large. And I'm a little bit, I got to say, I'm a little bit sanguine on the euro. I don't think it's going higher here.
Is the opportunity in the risk of equities, or is there any kind of stability and risk reward in EM debt?
Oh, yeah, no, EM debt, FX hedged. I mean, look, it's got a high beta, high correlation to U.S. Treasuries. If you're of the belief that U.S. Treasuries are going to do 7 to 10% in the year ahead, which we are, and a lot of people are, like J.P. Morgan and other smart people, then EM rates, FX hedged, should do 7 to 10% as well.
What's the most important factor behind the EM call next year, China or the Fed?
It's definitely China. I mean, well, look, it's China in terms of EM currencies. It's the Fed in terms of beta. And so, look, let's be clear. If you think of EM in terms of credit and equities, the high beta elements of it, it's going to be the Fed. But if you think of it in terms of rates, if you think of it in terms of EM local debt, you've got to kind of look at the currency. You got to look at dollar yuan. You got to look at euro dollar. And, it's two sides of the same coin. Euro dollar's really had a greater impact on EM currencies over the last year. It's not always been that way. It's been dollar yuan for the better part of the last 5 years. Are we moving back into that beta regime? I would say so, probably.
How would you frame it currently? Is this the path towards a full reopening, or is this just easing restrictions to keep a couple of people, in fact, more than a couple, happier after protesting a few weekends ago?
Jonathan, you're not asking that question. It's sort of a rhetorical question, right? Because
Which one
you
is
know it's the latter. You know it's what I'm going to say.
You think I've got the answers? You haven't got the answers. Come on.
You know,
Look,
basically dished up on a
the
plate.
China reopening, and don't get me wrong, they will reopen. It's just going to take a lot longer than we would have otherwise thought. And it's going to look very, very different than we've seen in years past because of the property crisis, because of everything that's going on the ground and the confidence or lack thereof in the economy. So, you know, look, I think China's a big deal. I think Asia, and probably curve flattening in Asia, is probably a trend you want to play at the current moment. But I think low yielders in Asia, yeah, I mean, that's probably where you want to park your money amidst the crisis that I see coming in the first half of next year.
One of the reasons why people think this is because a lot of the developing world raised rates ahead of the Fed and raised rates a lot more quickly, and we're much out front of what we see now from the United States. Can they be the first to start cutting and actually bring investment to their country, not go the other direction? Can that be supportive at a time when you don't normally get the same kinds of currency responses to cutting and hiking?
Well, Lisa, we all want to think so, right? We all want to play the receivers in places like Peru, Czech, Colombia, Chile, and Brazil. Those are the 5 economies that are probably going to cut rates in the new year. The extent to which they cut rates, I think we're only thinking cumulatively over the course of 2023, 200 basis points, if that, across all of those 5 economies or 6. I mean, that's not a lot of rate cuts. So if you're playing for receivers, you're not going to really get the juice there, I don't think. I think really for me, it's about spreads. I mean, it's going to be about credit spreads. And as you move into U.S. recessions, you know, we haven't seen it yet. You know, spreads gap wider, you know, and I think that's what, you know, we're all going to be looking for in the coming year, yeah.
So let's talk about your mother. You mentioned no, I'm kind of kidding, but I'm kind of not. No, but going way.
She hired.
Hold on a
she
second.
hired Rob Capito for Larry Fink back at First Boston.
Wow. Okay, but before we get into getting into all of that, I am curious about the experience of the trader out there on some of the desks right now, entering an incredibly difficult, very different reality where we have a motley picture of rates and inflation.
Yeah, no, what's the average age? Probably 24 or 5 is your average.
So what's the consequence of that?
I mean, well, look, a lot of them haven't lived through a lot of the crises we have. Admittedly, I'm not trading the market anymore every day, so I don't know how a lot of these markets are structured at the nuance, but, you know, I cut my teeth in the late 90s at Goldman Sachs in the short end of the curve doing repo and HICS and tri-party transactions. And for me, when you look at SOFR and you look at GC and you look at GC repo and you start to see some of the things happening there, we've been waiting for the cost of collateral relative to cash to start to move for now 8 months. And we're finally seeing evidence of that. So in collateral, there's more collateral out there than cash, right? Because the Fed's tightening the screws. You know, that's when things start to break. That's when you see crowding out of other asset classes. That's when you see issue problems.
You used the word crisis 2 minutes ago. It wasn't lost on me.
Oh, damn it.
Why did you use that word?
Well, because look, debt to GDP in emerging markets really is at an all-time high. You know, growth next year is going to be 2.9% across the whole of emerging markets. That's really, really low. China growth is going to be 4%, maybe. You know, these are not great levels relative to history. I wouldn't say they can start a crisis, but they are crisis levels. Now, admittedly, we talk about these distressed emerging markets out there, the Argentinas of the world, the Sri Lankas. I do think their maturity profile will allow them to sort of get through next year, but there's a lot of pain to be had there. So, you know, I mean, I say crisis only to kind of catch the attention of your audience, but I don't know if it's really.
I don't care. I mean, you follow this.
That's why I asked.
We'll let you
I'm pleased you admitted it.
That was fantastic.
No, come on. DeGrom's going to Texas and the rest. The Aaron Judge Derby, he turned on 213 million opening day. They're now up to 360 million plus. San Francisco and Yankees. What do you think?
I think 400. I mean, yeah, no, I mean, look, it could get there. I mean, look, what are they, 9 years, 360, something along those lines. I don't know why he'd play for the Giants. They don't have a short right field perch. I think he's probably going to want to stay in New York. But you know,
everybody says that San Francisco.
It's a lot of money. I don't know if that's
the right move. When Pharaoh came to New York, it was a lifestyle decision.
Where's Derek Jeter? Get me Derek Jeter back in the shortstop.
Have you watched the documentary on Derek Jeter?
Amazing.
Oh, it's
Captain?
awesome.
So
Loved
awesome.
it. It's just fantastic.
He's such a class act.
Aaron Judge apparently unhappy that they made that contract offer public, that number.
Yeah.
The 360.
The 200
Oh, the
plus.
213.
200 plus.
Yeah.
Because he felt like it was like putting him in opposition
And if you
with
saw the
fan
captain, the
base.
Derek Jeter negotiations, it was the same thing. You know, they just signed
Messy.
Brian Cashman to another 4 years.
So does somebody come out? Where are the Dodgers and the Angels in this? Could you see Ohtani
I could see I could see the Red Sox. I could see your Boston Red Sox slipping
nothing.
in there.
They're like the Italian
they're
soccer team
quiet.
of
They're like a
baseball.
slumbering giant up there.
Oh, please stop
come
it!
on in the frost.
You're killing me.
I'm still waiting for someone to explain the financial model of this. 300 million.
She had the best answer of anyone. Lisa Folk said Stevie Cohen.
No, in all honesty, this is actually one of the oddities of the baseball market is the major markets have amazing retail royalties, all of the products that they sell, incredible ticket sales. If you ever bought tickets, you know how expensive they are, and they're often sold out. Season ticket holders, all of these mass, and also contracts with cable companies, all of these revenue streams that give them a lot of money that they can then throw after some of the top talent. Is it worth it? That kind of goes to the whole Moneyball thing, and we can discuss
the American market is just absolutely massive. It's just amazing.
I think you guys did a great job with Maria earlier today.
Do you see how emotional that was?
You were really, I thought you were really classy.
Really sensitive.
The box and
I have no idea what she's talking about.
Dripping with sarcasm.
Amazing. It was amazing.
Football is a very emotional thing.
Obviously.
The World Cup is deeply emotional.
I've learned this, and seriously, will it be the same when it's in America?
Sure, it will be. You have to realize that for a supporter of Spain, for like Maria Tadeo, she views their performance as how the rest of the world perceives her country. Like, that's really, really important. So as an individual of those countries, you believe that people will have a different perception of your country and where you're from based on how that team performs at a single sport in a single game.
So when I say half back to the fullback, back to the center, Maria doesn't like
I think you're probably offending a lot of people.
Yeah, thank you.
We should get that. We used to have that Simpsons clip, didn't we, on radio? Do you remember that? Tom used to introduce me and play that. He'd come back from break and he'd play that clip. Joining us now, and I'd run off.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
There's a hopeful scenario where you can get a soft landing, but we need to be realistic.
I think most people are overly concerned with recession.
It's very likely that inflation is going to be persistent on the core level for some time.
The reality is that consumers are starting to run out of dough.
When the Fed is tightening to the degree they are, it's restricting the amount of money that's out there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. 8 o'clock for Global Wall Street. A sleepy Wednesday? No. We're going to blow up the show right now. Ian Lingen of BMO Capital Markets. John, just out with a brilliant, lengthy, piercing note. He says things are going to change. The 2-year yield will go up, and that matters to every listener, every viewer.
We've talked about Neil Dutter a lot from Renmac, who joined us last week and talked about a re-acceleration in the U.S. economy. He believes there's a big disconnect between where people expect the economy to go and where it is right now. And he thinks there's going to be quite a messy close of that gap, which ultimately could lead, Tom, to higher yields.
Ben Jeffrey and Ian Lingen go into hyper detail here across the curve, looking at other assets as well, and they zero in and they just say it's just simple. There's going to be more twos. The short end is where to watch versus the 10-year benchmark, and that's going to give you perhaps greater inversion.
So how does that 2-year shape your view of the longer end? And to your point, does that lead to further inversion? We've got Eric Nelson of Wells Fargo looking potentially for a level of 475 on a 10-year next year. Equities for me, Tom, looking out next year, going through all the 2023 outlooks. Bit of a snooze. 4K seems to be the average. I hear it a lot.
Well,
We're going to go
snooze,
down. We're going to come back up. The yield calls, though, with the likes of Steve Major at HSBC looking for 250 year-end 23. Wells Fargo looking for 475 on a 10-year year-end 23. You get the feeling someone's going to be very wrong on that bond market next year, don't you?
This is the conundrum into the oddest year of outlooks I've ever seen. And Lisa, we always know the Abramowitz world is out front of the equity world. There's no question about that. How dislocated do you see in your reading that bonds are from the equity market?
Not so dislocated. I mean, honestly, you've seen resilience right now, at least over the past couple of weeks in certain credit markets. From a broader level, though, on the front end, how much momentum is there that this Federal Reserve has to stymie? How long can it continue? One of the big distinctions for next year is whether we get a recession in the first half, the second half, or the first half of 2024. How far are we pushing it out based on some of the strong consumer spending and the strong inflationary reads we've been getting?
And we heard this from these executives yesterday, Mr. Diamond over on the Death Star, Mr. Solomon with Sonali Basak here, given the economic line of recession, and yet there's economists like Neil Dutter, like Solomon's Jan Hatzius, John, that just say, no, it's a lesser likelihood than the gloom that's on my screen this morning.
So you've got the economic data, you get CPI next Tuesday. Then it's all
To me,
about the
that's
Fed's
everything.
interpretation of the data on Wednesday and how they project forward from there. I'd go further than that. It's also about the Federal Reserve and Chairman Powell specifically, his view on risk management. And I keep going back to this. I think this is the key driver of markets right now. The Fed's view of risk management when it comes to Fed funds. Do they think the bigger risk is over-tightening or under-tightening? And what emphasis does he use in the news conference? At the last news conference, he repeatedly talked about the risk of under-tightening. He talked about asymmetric risk, and they talked about the ability to correct over-tightening. Now, I know many people sat there and listened to Chairman Powell at Brookings last week and said, no change, nothing. But for a lot of people in the market, they did see a shift, and it was a shift in emphasis as he talked about an unwillingness, or at least the lack of desire to over-tighten.
I wanted to talk to Damian Sassar about this, but Aaron Judge's chit-chat was more important. Lisa, what's percolating out there is not a liquidity crisis, but I'm going to call it a liquidity concern out into next year. That's I don't think it's in the zeitgeist, yes, but it's percolating.
Crisis was a better word because it gets everybody's attention. How do you discern something that is a problematic development? We're already seeing that. The big price swings that we've seen, the big yield swings in benchmark rates, kind of shocking.
Well, let's just the data here. John, I'm going to look at the Bloomberg Financial Conditions Index. It's still not where Mr. Powell's. It's a little better than the accommodation of 2 days ago, but negative 0.59 is nowhere near where Chairman Powell wants
I mentioned Chair Powell last week at Brookings. We've taken back all of those gains. After that address by Chairman Powell, we are back to the levels before he spoke on the S&P, and we're negative this morning by 0.6 on the S&P and much more so on the Nasdaq. Yields a little bit higher by a couple of basis points. Tom, your 10-year, 354.95.
It is a jumble. Some would say almost inchoate here. What we're talking about here, all the backs and forths. Someone that needs to distill this is with Northwestern Mutual Wealth Management. Brent Schutte joins us now, their Chief Investment Officer. Brent, did you take your outlook for 2023 from 55 pages down to 12? I mean, are you going short and sweet here, or you're writing War and Peace here on what we're going to see next year?
Right. I think we're more on the short and sweet type and trying to be understandable and make sense. And to me, I think, we're switching from right now inflation fears to recession fears. I hear the word recession quite a bit, and this is what we thought would happen. So if you think about it, inflation fears drove us lower till October 12th. That was the day before core CPI topped. And so I think what you're seeing now is the commentary that the Fed has done too much. You're seeing it in the bond market. The bond market is telling you that inflation is a thing of the past and that the Fed has done too much. And that's what I think likely drives trading for the next few months, where you see these recession fears come out. Once we see that inflation does not survive a recession and that the Fed will pause when they actually see jobs being lost, then I think you can move higher in a more sustained pace.
If we agree that inflation coming down is what's called a highly stochastic, it's pointy, folks. It goes up, up, doom and gloom, and then it comes down rapidly, as it did twice after 1947 and other times as well. How does the allocation or outlook of your investment recommendations change if inflation only comes down to 4% and not to the proverbial 2%?
Yeah, I mean, I think that's what most people are saying right now, largely because the New York Fed UIG underlying inflation gauge shows 4% inflation as being kind of the more persistent part of it. And so, I just don't think that we stay at 4%. I think it does pull back. I don't think we're going below 2. I don't think we're going back to the last decade that we had where we persistently worried about deflation. That to me was not, inflation wasn't a relic of the past. That was how we were positioned then. But we are certainly positioned more for it coming down in the next few quarters. For example, we actually upped our allocation or increased our duration towards fixed income in the middle of October because the Barclays aggregate was yielding 5% versus 1.75 at the start of the year. Bonds now provide real value. They provide a hedge against downturns in equities caused by recession. And that's where we've kind of focused on the bond side. On the equity side, we're still on things that are cheaper. That has been what has worked this year. That has been what I think will continue to work next year. And so we own the S&P 600. It trades at 13 times next year's earnings that have already been marked down by 14, 15%. Mark them down 10 more percent or 10 more. We still are at 15 times. And so we're in things like that, and I dare say international developed is becoming more attractive because I think the dollar will fall next year.
So, Brent, do I hear 60-40 going into 2023? Is that what I hear?
60-40 was never dead. It's not dead. It needed commodities in it. We had those. And now I think it's actually going to be a much better place going forward. I mean, equities have done the heavy lifting for the last 10 years. Now bonds offer some value, and so certainly they will be a way that holds up the 60-40 as we push forward into 2023.
Lisa, that's a big change, isn't it? Coming into 22. Do you remember that? 60-40's dead.
Yeah.
It's over. And 60-40, let's be clear, this year. Brutal.
It was devastated.
Brutal.
And how much do people buy that 60-40 is back, especially after the brutality that we just saw?
Well, Brent, that's the question. How perceptive are other people about the thing that you see? How receptive are they towards what you're saying?
Yeah. I always like to hope to be a little bit contrarian in nature because I found that's usually the right place to be. And so, I do think people are worried just because the 60-40 hasn't worked and that narrative has been that it's dead. I think most people think of the 60-40, unfortunately, as just large cap growth and investment grade bonds. I think you need to have things like commodities in there, something that we've owned because we didn't think inflation was dead. Something like small cap, something like international stocks, which is no one wants to own those just because they haven't done well. But if I look back at economic cycles post 1980, every single economic cycle had different leadership. The S&P and IFA alternated. I'm not suggesting that it has to be, but I think as you push forward, you're in a different type of environment where inflation will be above 2%, where there will be different worries, where there will be shortages on different sides of the economy. And I think that's going to drive us forward. And I think 60-40, if you look historically, going back to 1926, we've only had 4 years where the bond market was negative when the stock market was negative.
Brent, you
and
mentioned
those were all dictated by high inflation, which I don't think we're going to have next year.
Brent, you mentioned commodities, and let's end there because we've been talking about the divergence between energy stocks and other commodity equities that are doing very well, and then you're looking at a crude price that's the lowest going back to December of 2021. What gives there? Can you have conviction to continue buying energy equities in the face of prices that are dropping in the crude space?
There will still be companies that make money within the crude space. I think you just need to focus on picking the right ones. Certainly, the easier money has been made in energy. That's been the sector that has done well over the past few years because no one wanted to own it. Now you have more people wanting to own it. And so I don't think that it's all negative, but I certainly think the easy money has been made as you look forward. And certainly the price of oil is still something that is going to be highly variable based upon what is happening in the economy. I think right now it reflects the reality that we are moving more towards a recession. Certainly, I think the good news is we've had rolling recessions over the past year, just like we had a rolling recovery. And I think that helps take the starch out of any recession as we push forward, as does the state of the U.S. consumer, which is still in good shape.
It's always easy money after the fact, isn't it, Tom? They never tell me ahead of time it's going to be easy money, looking ahead to the year ahead.
I think the best you can do, John, it's a really important insight. And the best you can do is try to gauge consensus. And it's not going against consensus when consensus is sort of kind of like.
Yeah.
It's when there's a massive consensus bet. And the question is, are we there now?
Brent Shitty of Northwestern Mutual Wealth Management. Brent, you know I'm joking at the end. It's great to catch up, sir, as always. 60-40's back. That's the headline there from Brent, looking ahead to
4 years
23.
out of umpteen that he mentioned here. And you know, you got to go against it. I mean, when was the last time we had a bond market? I mean, Lisa, 2 years in a row back to back of the grimness of this year in bonds.
It's been brutal.
It's not visualized.
You know, this is what a lot of people are saying is that 60-40 has both problems potentially going for it next year.
When did we last see, John, as you've framed out beautifully, the market SPX at 4,000 right now, 3,923. And we're going to move 42 points in the next 12 months.
It's going to be quite a trip on the way. Savita Subramanian.
It's going to be a journey.
I'm catching up with Savita from Bank of America.
A journey.
An emotional one. I'm catching up with Savita in about an hour from now. And Savita thinks, bear case, the downside, you could see 3K. Can you imagine that?
Well, Mike Wilson agrees.
Yeah.
I would ask her, I think she's provided world leadership on ESG. I'd ask Savita Subramanian.
She's awesome. The whole
the
team is
future of ESG.
It's great to see Gapin over there as well, you know.
Yes.
Over at BFA.
Had a good year.
Lined up with Savita. Coming up very shortly, we'll catch up with Henrietta Trays from Veda Partners. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Incumbent Democratic U.S. Senator Raphael Warnock has won re-election in the Georgia runoff. Warnock defeated Republican Herschel Walker with a little more than 51% of the vote. Walker had been handpicked by former President Trump. Warnock's victory allows Democrats to hold a real majority in the Senate with 51 seats. Two of Donald Trump's companies have been convicted in a criminal tax fraud trial in New York. They were found guilty of engaging in a scheme that allowed executives to evade taxes on company-paid perks for more than a decade. The former president wasn't charged, but prosecutors told the jury he knew exactly what was going on. In China, it's a major shift from the COVID-0 policy. Today, Beijing eased a range of restrictions aimed at preventing transmission of the virus. They included allowing some people to quarantine at home instead of in centralized camps. Plus, authorities have scrapped virus tests to enter most public venues. China's government has been under pressure to change its approach. In Germany today, more than 3,000 law enforcement officials conducted raids aimed at breaking up what authorities called a coup attempt. According to prosecutors, they detained 25 people linked to a far-right terrorist group that wants to overthrow the government. It's called the biggest ever raid targeting right-wing extremists in Germany. And Southwest Airlines is reinstating its dividend after a halt of more than 2 years. It becomes the first major carrier in the U.S. to resume shareholder payouts after they were suspended during the pandemic. That was one of the conditions of receiving government financial aid. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
As many of you know, we work with TSMC to manufacture the chips that help power our products all over the world. And we look forward to expanding this work in the years to come as TSMC forms new and deeper roots in America.
Tim Cook, the Apple CEO, the stock this morning down by a little more than 1 full percentage point. Lisa, you've been looking at this. I think we've been focused on the supply side story, but it's the demand around the Apple iPhone where I think there's just a little bit of uncertainty.
Yeah, that basically, even if there are some real problems with supply, that it doesn't really matter because demand will overtake that and won't necessarily offset that. That's what we've been hearing from a number of producers. And also, we saw Morgan Stanley downgrade Apple as a result of that.
I've been doing my channel checks.
Can you guys smile
TK,
like
on the new iPhone.
we get
Honestly,
along? Here's a channel
you
check
are like a
for you.
child with a new
John,
toy.
John,
is it that good?
The only one in the house that doesn't have a new Pro 14 whatever is Kennel Feed.
Did you do the family plan?
Bill. Yeah, I did the family plan. T-Mobile, they say I'm just like Magenta.
So I'm fascinated by
whatever.
this. Is that where all these big sales are coming from?
Okay.
Through the carriers in America?
Stop the show. Henrietta Trays is taking notes in Washington. We got to, get to it. As quick as I can, when somebody tells me this costs $1,200, I just laugh at them. You get in, the gimmick is you get in for nothing or near nothing because the phone companies are battling. Tim Cook, we show him, great. Glad he was in Arizona. We should be talking to the head of Verizon, head of AT&T, head of Magenta, Mr. Legere, and the rest of the geniuses at T-Mobile because they're the ones driving these sales in America. China, I don't know so much.
Same thing in the UK. Similar story.
I'm gonna get you out on 48 megapixels.
Okay.
Driving technology forward. Should we do a data check here before we go to Henrietta?
I mean, if you want to do that briefly, sure.
So caution on the screen.
Apple's down 1.4%.
Thank you.
Futures are negative 25 on the S&P. We're down about 1% on the Nasdaq, down about 0.6 on the S&P 500.
What's going on? Let's go to Washington now and figure out what happens, not in Atlanta after Georgia, but what happens in the white marble at Capitol Hill. Henrietta Trays joins Economic Policy Director with Veda Partners and Sirius Capitol Hill cred. How does your world change now? What does a gridlock look like in 2023?
Well, helpfully for the Democrats, they are locked and loaded in the Senate. They've got their 51 seats. They can hold committee hearings. They can confirm whoever they need to. It's going to smooth passage and honestly lift the fog of the last couple of weeks that has sort of settled over D.C. as everybody on the Democratic side and the Republican side wait for the outcome of last night's election. So that decisive win should clear us up on a lot of really niche issues, things like whether the Boeing jets will be certified, whether the Durbin Amendment on Visa and MasterCard will be approved, whether we can't get a pipeline permitting bill through the government funding package. But there's hopefully going to be a lot of movement.
So maybe the power changes for Joe Manchin, Sinema of Arizona, in that on the Republican side, where McCarthy's not even sure he's going to be Speaker, are there Joe Manchin-like people or a cadre within the House Republicans that can block what McCarthy and the Republican leadership want to do?
Yes, absolutely. I mean, there's a 4-vote margin, and I would say that in order to be functional for the big tent that is the Republican Party over on the House side, Kevin McCarthy or whomever the next speaker is really needed 20 or even 25, 30 extra votes in the sort of middle of the road camp. Now you have a very fractured Republican conference in the House. I think it'll be really difficult and fascinating to watch the January 3rd election for Speaker. And then again, as we get into, call it July or even September at the latest, the debt ceiling fight. It could very well be that whoever the speaker is in the beginning half of the year is not the speaker in the back half of the year, based on what they've got coming.
We started this conversation talking about the iPhone and the TSMC production outfit they're building over in Phoenix. We haven't talked about who's going to staff up some of the production that we're onshoring or nearshoring. How much are you seeing that continue to percolate in discussions in Washington with some real policy of how to bring more people back to the labor force and train them for some very highly specified roles?
It's funny you mentioned that. I was just at a lunch with a guy that you guys speak with all the time, Torsten Slok at Apollo, and we were talking about exactly that. How are we going to get immigration to tick up so we can get everything from those high-tech jobs down to the farm workers in? And there is a couple of separate bills that are pending right now. I do not have any kind of high odds that they'll be approved before the end of this year. I think the split in the House and Senate is just too severe and to get anything on immigration done, even helpful stuff. So to that end, I sort of look to Mexico. There's been a lot of talk from, for instance, the Commerce Secretary about how you can get a really helpful supply chain build out on testing these products or packaging these products from Mexico, which would be nearshoring or friendshoring. So I think to look for a lot of that, a lot of optimism on that front. I don't know that there will be an immigration deal that brings in a whole host of workers that we're obviously going to need for those new production facilities in Arizona and elsewhere.
Well, and these are the two issues that I've been looking at. The labor market, everyone's saying it's so tight in the United States, and then we're building out these factories and wondering, okay, well, who's going to come in and work for them? And the second point has been gasoline prices that have been coming down dramatically, and this has been one of the key hallmarks of President Biden's past couple of months in terms of the SPR releases, and we're seeing now crude prices almost down to that threshold where they said they would start buying and rebuilding their inventories. When do they pull the trigger? How much are you hearing conversations about that in D.C.?
I think there's a lot of mixed bag on the oil and gas front. One of the areas that I've spent a bunch of time recently is the idea of that windfall profits tax out in California that we're monitoring very closely. I do think that there will be efforts to replenish the SPR, especially after we've depleted it for the last however many months now. So I do think that there is a lot of encouragement for that, and that would be done at the administration level, so hopefully you don't need Congress to weigh in on that. But certainly you see a more proactive House and Senate members writing a lot more letters, trying to advise the president, trying to advise the Fed on what they should do from here on out. And it's really going to be up to the agencies, up to the executive branch, because Congress is not going to get anything done after, call it December 23rd, to be generous.
Henrietta, are incumbents more entrenched as we move forward?
I think incumbents are definitely entrenched, and what we have here is a unique situation where so many of the House Republicans are relative freshmen. They've all come in since 2016 when President Trump first won. Last time I checked, I think it was like 75% of the House Republican Conference is all new since 2016. So technically they're incumbents, but that's a pretty kooky set of incumbency environments or experiences that they've had. So I would expect for incumbents incumbents to sort of stick with what they know, caucus pretty hard, especially on the Democratic side, where Hakeem Jeffries is going to try to, figure out how his caucus works. But the Republican conference is so fractured. Incumbency means sort of a different thing on that level. You're going to get that freshman class, or that since 2016 class that acts a lot differently than the old guys.
Never boring down in Washington, Tom.
She's great. She says
she's
the
fantastic.
best value in the shortest time. I think maybe Valier can compete, but it's just I learned so much there.
Henry Trace there at Fader Partners. Do we have a new Time Person of the Year?
We do. This is really important, and I want to go back to 2007 with immense respect for Keith Grossman and the team at Time. Time Magazine 2007 said Vladimir Putin is our Person of the Year, and this was because he took the country from chaos to, quote, the table of world power, was the quote in 2007. And today it is Mr. Zelensky.
And we got some chaos. Haven't we?
Chaos.
Big time. 15 years later.
To review this with Maria, I thought she was lights out today. Forget about the World Cup chit-chat. They put a drone attack within, I'm going to say, 90 to 100 miles of Moscow. Can you imagine a drone attack? Let's not make jokes about it, but say of Canada on Albany? I mean, that's what we're talking about geographically.
Well, to your point, Tom, there's still a war ongoing. We'll be going into a new year as well.
In the length of it, yes.
And there are some people saying that we're still underestimating risk in Europe as it pertains to the energy story. This is the Time Person of the Year. Can I just fit this in? We spent the morning talking about the World Cup and Spain's loss to Morocco. Let's talk about Morocco's win over Spain. The gentleman that scored that last penalty kick, Ashraf Hakimi, born in Madrid, Moroccan parents, mother was a cleaner, father was a street vendor, came up through the Real Madrid Academy, chose to play for Morocco, and scored that final penalty, Tom, to beat Spain. Just absolutely phenomenal story. Phenomenal.
I mean, I think Lisa's better than me on this. My geography on this, I simply failed yesterday. I had no idea some of the nuances off of Gibraltar between Morocco and is it Melilla, the little town of Spain that's on the North African coast? I mean, Lisa, it's like back to Barbary pirates of Thomas Jefferson.
Brothers playing each other. It's so close, and it's basically
Amazing.
What you just highlight, and the fact that he chose one over the other, but shows the unity and the closeness of these two nations.
Congratulations to Morocco.
Who do they play?
A little bit later, Portugal, later this week.
They play Portugal.
Yeah.
And they've got a new guy. I mean, I love that a 40-year-old almost scored for Portugal.
Ronaldo's gone, eh?
Yeah.
It's not looking good for him.
Yeah.
Replaced. From New York City, this is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back.
And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Good morning, everyone. Bloomberg Surveillance, Lisa Bramlett and Tom King, John Farrell preparing to get you through the 9 o'clock hour worldwide on Bloomberg television. A little bit of weight to the tape here. Futures negative 19. The VIX out from 20 level, even 19 level. A few days ago, the angst of 4 or 5 days, 22.82 is well. We turn to New York Mets fan Bramo right now. And I can tell you, folks, this is really something. You got a photo out on Twitter not far down from the fold, put out 12, 15 hours ago of the great Aaron Judge in a San Francisco Giants uniform. And Lisa, Ken Rosenthal and the great John Morisi saying maybe not. There is out on Twitter. I don't really have a confirmation, but I'm going to go with it. Mr. Judge will stay in New York and not with Stevie Cohen.
Not with Stevie Cohen. I think that's why you're wind up about me being a Mets fan. $360 million deal for 9 years with the Yankees, that being reported by The Athletic. $40 million a year. Not too shabby.
I'm going to make it, just to move on here to our important guest, but folks, with Paul Sweeney, we'll cover this in the 9 o'clock hour on Bloomberg Radio with Sweeney's media expertise. And I'm sorry, Lisa, it's just simple. Sports wins. There's all this death and doom and gloom about it. And when we're chatting up World Cup and, all the rest of it, the fact is you see it in the signing season of baseball, big money is being thrown around.
You say that there's such emotion in football and in soccer. There's also a lot of emotion in baseball. There's a lot of feeling with this, and you could feel that in Anne Marie's tweet.
Yeah, I just got an email in. I look at folks, the desk transfers within Bloomberg. I'm on that feed, and I notice that Michael Barr's put in a desk transfer to get as far away from Bramo as he can, with Verlander now going to the dreaded New York Mets. We get back on topic now with futures negative 15. The VIX again, 22.73. Blarina Arici joins us now, U.S. economist at T. Rowe Price. Blarina, thank you so much for being with us. My head is spinning over what the actual view of the American economy is, not the guesstimate out 6 months. Where are we right now? What's your working figure for some form of inflation-adjusted GDP Q4?
That's a great question. Everybody's confused because we're getting such mixed messages from the data. Is the labor market accelerating, even though the Fed has been hiking at such a fast pace? What's going on with growth and consumer spending? I would say in Q4 of this year, the U.S. economy is shaping up to expand at a healthy pace, probably 2 to 3%. After being adjusted from inflation. And once again, what's pulling through the U.S. economy is the consumer spending data, both on services and goods for the beginning of Q4. We're pretty solid for services as well as goods. So yeah, we're in a good spot right now, but I think more deceleration is to come next year, unfortunately.
The outlooks of the sell side are extraordinary this year. I've truly never seen the chaos, the cacophony is out there. What are you advising portfolio managers at T. Rowe Price? You guys invented on the buy side a fractious debate. This is, folks, I'm going to say 40, if not 50 years ago. Are they listening to you? And if they are, what's the line for them of how to be invested given this chaos?
So how do we navigate these cross currents that we're facing in 2023? I would say that the main thing is we expect interest rates to continue increasing. That means there's going to be yields in those fixed income portfolios that we manage. However, as we look at the question of whether do we add risk or do we not add risk next year, the outlook for employment growth and consumption growth slowing in 2023 means that we're tentatively more conservative when we're positioning ourselves with respect to risk.
We were talking with Jim Bianco of Bianco Research a bit ago, and he was saying there still is this feeling of transitory baked into people's expectations. It's just been pushed out, that basically there'll be an immaculate disinflationary force that will come into play at the end of next year and allow the downturn to not be as severe as some people feared. Do you adhere to that kind of idea?
Well, I think lots of questions for the second half of next year. First of all, I do think the Fed will get some help from the transitory question when it comes to inflation, and we're going to start seeing that concretely in core goods inflation in the first half of next year. So I think that will be a factor helping the outlook for next year. However, when it comes to the question of a recession, I do notice as well that lots of commentators are saying just because we don't see the imbalances right now, that this is, if we do have a recession, is going to be a shallow one. I don't think I necessarily agree with that. I think once recessionary processes take place and start to get into motion, things break in the economy that we don't necessarily anticipate. This is what happens in every recession. The other factor that I think weighs against the U.S. economy next year is that monetary policy has been tightening at a very, very fast pace compared to the last 20, 30 years. And the other one is that it's facing a very adverse global environment with growth in China slowing, growth in Europe slowing, contraction expected actually in Europe for the first half of this year. So the external environment is not that favorable. And then domestically, we have very tight monetary policy as well.
Given the headwinds, why do you think the Fed is still going to get to 5%?
Well, I think the headwinds are more based for the second half of the year. And I think the Fed is so focused on realized inflation and the trend of 3-month moving annualized average of core inflation that I think it will need to continue hiking and delivering on those hikes that have been already priced in the market.
Well, Sebastian Page emails in. I'm kidding. But for Sebastian Page, who's expert on diversification, his wonderful book out on allocation in realities, folks, a colleague of Blorina's at T. Rowe Price. Blorina, one of the great things Lisa and I see is OECD views, grim. IMF views, grim. Is now, this is a loaded question, is now the time to buy international and EM equities? That's simple.
So this is the most anticipated recession in history. Is that what you're saying? So has all the bad news been priced in, and is it time to dip into those more risky assets? I think we're still on the fence about that because of the question that we just discussed, that once we get into a recession, things can break unexpectedly. So I think we're still being a little bit more cautious in our portfolio allocations. And Sebastian will be able to tell you more.
I think this is a very fair answer. You know, we make jokes about people on the fence, but I think there's a huge body of people right now on the fence about go long EM, go long international, burnt once, burnt twice, burnt 3 times, 4 times, on and on and on. There's a lot of people on the fence.
Especially when we hear about the debt to GDP that Damian Sassar was talking about near record highs, which is going to be a pervasive concern for a longer period of time. Blorina, when you look at what's going to happen next year, how much confidence do you have that the inflation is going to come down enough to support this expectation that we see over at HSBC, for example, that the 10-year is going to get down to 2.5% because of that long-term reversion back to what we used to know?
I think there are some tailwinds for inflation next year. So Chair Powell very helpfully split this into 3 pillars in his speech at Brookings last week. I think the first pillar of core goods is coming down significantly next year. We still have the effect of the dollar appreciation feeding into core goods with a lag. I think we have those rising inventory levels and slowing consumer demand on or consumer spending on goods and the improvement in supply chains, as well as transportation costs. I also look at private sector rental prices. They do feed into the rent components of CPI with a lag. And I think they're telling me that around the second quarter of next year, we'll get significant progress there as well. But I think on average, even if inflation remains sticky in the other services components, on average is going to be trending down in a sustained basis. But we shouldn't extrapolate this into the Fed is going to cut rates significantly immediately as we hit a rough patch in the U.S. economy.
Just real quick before we let you go, where have all the missing workers gone? This is something that Jay Powell has been talking about.
Great question.
This is a great question, and we did a deep dive across our fixed income division here to look into some of the factors that are keeping labor supply so depressed. The ones that really stood out to us is the interaction, first of all, of demographics and COVID. We knew that we had a demographic headwind to labor supply, and then COVID made people retire even sooner than they would have otherwise. We also have a big hole in our labor supply from the lack of migrant workers. Immigration visa processing collapsed in 2020 and 2021. We estimate about 1.5 to 2 million workers are missing from this. And then we have other more structural long-term factors that are keeping depressed, the prime age workers, especially male workers. So lots of demographic, lots of structural factors keeping labor supply low. Can monetary policy do anything about this? We don't think so. So they just have to bring down demand for labor.
Very good. Blarina, thank you so much. Blarina Arucci with us with T. Rowe Price as well. I want to go back to, without question, the midweek note from Ian Lingen of BMO Capital Markets. Folks, he writes always one of the most densest, read it every word note on Wall Street, and it's usually, I'm going to say, 2 Bloomberg screens. This time around, it's 4, 5, 6 screens. And Lisa, I literally have to go back and read the note, I'm going to say 3 times to get some of the dynamics. What's the dynamic to you that Lingen and Jeffries write about today at BMO Capital Markets?
A sizable chance of 5.25 or 5.5% Fed funds rate, terminal Fed funds rate this cycle. It is much higher than what the market is currently pricing in. It is that is not insignificant, and that means that curve inversion is going to be even steeper, which goes back to, we've been talking about, yes, this is the yield curve is inverted the most going back to 1981. Is it perhaps questionable why it's not even steeper?
And on radio, I got my hands out here. Do you suggest then that it's the 2-year dynamic, as Mr. Lingen suggests, that will move the inversion either way versus the 10-year one?
You know, this is the mystery. That's what he's saying. I think other people would disagree and say that the dynamic comes in the other end. HSBC in particular coming out with a forecast of 2.5% 10-year yields by the end of next year. The real question here, will the Fed have the conviction to go as far as they need to go to curtail longer-term inflation expectations?
Right.
And you'll see that out in the long end.
Trenchant analysis at Bloomberg Surveillance of our sports coverage. And we go to our sports colleague, Anne-Marie with no E, who's out with an important tweet here. I mean, it's real simple, folks. Gracing us with her New York Yankees jacket as the Yankees failed to move forward this fall. Mr. Rosenthal of the bow tie. We only show Ken Rosenthal because of his classic bow tie. New York Yankees are nowhere for Judge.
Okay, can I
Stevie,
just say,
Lisa, look at that.
The sadness of Maria, the glee of Anne-Marie Herdern, such emotion from our team here. Just really...
The constant theme, the theatrics, the cinema of Bloomberg Surveillance. Rumor has it, we'll do this tomorrow. We'll have to see on that. Futures -12. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Democratic Senator Raphael Warnock has turned back at Republican Herschel Walker in Georgia's runoff election. Warnock was reelected with a little more than 51% of the vote. His victory will give Democrats a 51 to 49 edge in the Senate, making it easier to legislate. Walker had been backed by former President Trump. China is retreating from the wide-ranging COVID-0 policy that it blamed for the damaging of the economy. Beijing will now allow some people to quarantine at home instead of in centralized camps. It's also scrapping virus tests to enter public venues. COVID-0 pushed down consumer and business confidence and left people stuck in a cycle of outbreaks and lockdowns. Mortgage rates in the U.S. have fallen for the 4th week in a row. According to the Mortgage Bankers Association, the rate on a fixed 30-year loan fell slightly to just a little more than 6.4%. Rates have fallen as the Federal Reserve has signaled it will soon slow down the pace of interest rate hikes. Uber is launching its first robo-taxi service. The ride-hailing company will offer customers self-driving trips in Las Vegas. Uber is partnering with Motional, a joint venture between Hyundai and Aptiv. The test run comes at a time when the hype around self-driving vehicles is fading. And shares of GSK and Sanofi are surging today. A U.S. judge rejected scientific evidence behind claims that the heartburn drug Zantac can cause cancer. That means the drug makers don't have to face more than 5,000 lawsuits. A group of plaintiffs' lawyers say they'll appeal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer today on Bloomberg.
War I think there's some headwinds given we're changing economic conditions, but the competition for talent is still very, very strong. Now, how that evolves in 2023 is unknown. Certainly, if we have a slower economic environment, it will have an effect.
There's still talent. We seek talent all the time. We bring them in the company. We're just more careful about it in times like this because, frankly, we have great talent. We want to make sure we can pay them and promote them and give them opportunity.
Managing the message, Mr. Solomon, Mr. Moynihan, Mr. Diamond on the Death Star as well yesterday. Everybody talking up the view forward here on economics and maybe a little bit of bank talk as well. For Global Wall Street, we welcome all of you on radio and television. Lisa Bremowitz and Tom Keene. Mr. Farrow prepares to move forward at 9 o'clock. Straight talk now on what you care about, which is the future of Credit Suisse, and maybe we'll talk a little bit about the body count here after the pandemic boom in financial services. Allison Williams, definitive on this with Bloomberg Intelligence. Back to Payne Weber, back to the certitude. Remember, Allison, we believe. And whether it was Smith Barney or E.F. Hutton or Payne Weber and all that, you were too young to remember that, but I certainly remember it. What I want to talk about is I got a boutique firm being built, I believe in New York, called Credit Suisse, whatever, First Boston, I don't know what to call it as well. What is Credit Suisse going to plant in New York in the coming quarters?
I think that is the question. They came out with this strategy. Everyone wanted it. There weren't enough details. That shouldn't be surprising, right? Because they had to come out and study the stock. The most important thing for Credit Suisse is they came out, they raised the capital. We still don't know how that looks in terms of capital adequacy because they announced $1.5 billion pre-tax franc loss for the fourth quarter. So obviously that takes back some of the money that they've raised. But the real questions ahead are, what happens with Credit Suisse First Boston? Can they successfully spin this out? It's sort of interesting and a nod to some of the boutiques that we've seen, over the last 10 or 15 years, started by a lot of the star bankers. It's interesting because they can sort of tie comp to the business and away from trading and a lot of the other troubles. But then we have there's a lot of other moving parts, and it remains to be seen if they can get this done. Restructuring is never in a straight line, and it's never good to be in a poor revenue environment.
It's amazing. It's a group email. David, Brian, and Jamie email in all together and say, ask Allison about the boutiques. This word boutiques is smaller, more nimble. Good morning, Roger Altman and the rest that invented this. But the boutique firms, do they have the high ground going into next year because of big bank struggle?
Well, they're preparing for it, right? So they're picking up talent. I would say that even though, 'tis the season that for a lot of good things, but a lot of bad things in terms of, we'll be hearing about job cuts, we'll be seeing headlines going to the year. But when you look at the numbers, they're very small in the context of the growth that we've had. And I would point to Solomon's comments in the interview yesterday where he said, competition is surprisingly strong. That's because of the boutiques. But I would also point to Daniel Pinto comments, the head of JP Morgan's investment bank, a couple months ago. And he said, look, we're going to cut comp and not bankers because we don't want to be in the position we were in the summer of 2021 when they were scrambling to add people. We saw the headlines then about the junior bankers getting those people in place. The pipelines are still good and healthy. That was something we've heard consistently. We've heard it all year. We need those pipelines to execute. And I do think that bankers are going to hold out hope that if we can get some momentum or some strength in the seasonally strong first quarter, maybe some deals can get done.
Let's go there and really highlight how confusing the message from all of the bank CEOs yesterday was. On one hand, they were talking about a potential downturn. On the other hand, they were talking about resilience. They were talking about, yes, consumer spending declining, but not that much. Competition very strong, still need for the people, even though Morgan Stanley did cut something like 1,600 jobs, or is planning to. Not even getting close to where we were pre-pandemic in terms of how much they've expanded. What was your big takeaway? Are things bad or are things not really that bad, but they want to sort of justify any moves that they make going forward?
I think things are slowing, but I think what they're trying to put the context of how well positioned they are to handle it. So this is sort of the opposite of where we were going into the great financial crisis, right? So banks were highly levered, not prepared for the significant downturn. And then the pandemic again. So the last two cycles we had were crises. And we're going to have a credit cycle, but we think it's probably something more like the 2000 credit cycle, so a normal credit cycle. And the capital levels are so much stronger today than where we were entering then. I'll just give one more statistic, which is I thought was a great one that Jamie threw out at the last conference call. 6% unemployment, $6 billion they have to add to reserves. That compares to $15 billion over a couple of quarters in the pandemic.
This is kind of controversial. Are we seeing revenge of the big banks in terms of the shadow banking system that grew up around them and really stole a lot of the lending business over the past couple of years, suddenly stuck trying to figure out how to evaluate some of the private assets that are being called into question increasingly by some investors, whereas the big investment banks have pretty pruned back balance sheets and are able to kind of ride through this?
They are, because it has been, you could look at the crisscrossing lines. The share of credit has left the banks and gone to the funds. Private credit, private equity used to be the thing. Private credit has really been the area of interest. And, going to your point about slowdown, I think that's where we've heard some of the more worrisome talk, just in terms of these huge firms and talking about they think things are going to be, things have slowed, and they see that slowing through the first half.
Gina Martin Adams, you use stocks and you rebalance it every 90 days. Where do banks play a part in that? Are they a value when you do a factor analysis? Do the banks relatively look good right now?
Banks are generally value stocks. in terms of the valuation, we don't necessarily do that at Bloomberg. We can talk low and high. There's by some metrics, they're not, screamingly at the low end. I think, we have seen some rebound off the lows, obviously. But what Gina says, which is interesting, is that we are still looking for an environment that could favor value next year. And so after several years of growth, well outperformance, value has had a good year, and she's looking for fair value next year, pretty flattish returns. Value outperforming, that's pretty similar to what we've seen recently.
If Credit Suisse was an American bank, could they exist today? Are they getting a special pass by the Swiss government, Swiss regulators?
They're not getting a special pass. I think the capital raise was really necessary in order to bring them in compliance. But the interesting thing about the Swiss banks is those two banks, specifically, UBS and Credit Suisse, if you look at their balance sheets, maybe not today, but in general, those balance sheets compared to the economy, the Swiss economy, is so important that their capital ratios are much higher compared to a lot of the global peers. They're much higher regulated, and a lot of the fears around Credit Suisse, keep in mind, are meeting those higher requirements.
Allison, thank you so much. I got like 14 more questions. Don't be a stranger here. Allison Williams with us with banking, Bloomberg Intelligence. What'd you get out of that, Lisa? My head's spinning. I got no idea what to do there.
Just this idea that perhaps next year the banks will be in a position to pick up some of the advantage that we're seeing with respect to trading, and we've seen that in some of their balance sheets, so that we have seen a resilience there. The question mark has really been outside of the banks, and that's the reason why we had such a nuanced kind of message. On one hand, yes, we potentially could get a recession. On the other hand, they were trying to sort of portray this image of resilience and strength.
Let's do some market research here. When was the last time I was in a post office? When was the last time I was in a bank branch? Like forever. What are we waiting for? I mean, I know there's a roll up of branches and all that, but I just wonder with the tensions that are out there right now, if the whole thing gets sped up, the whole digital thing gets hyper sped up. I don't know.
Well, that's one thing that I think a lot of people have been looking at is the investment in digital and how that pairs with the appeal to the consumer, like Marcus, for example, which I know you have very strong feelings about, and what Goldman Sachs is going to do with that effort.
Yeah, we didn't get to that with Allison. Can we just state that Anne-Marie Horton is out of control this morning? I mean, the number of emails we're getting in on the judge signing. She's
out of control. So we're giving Maria a podium to talk about her heartbreaking experience with Spain, and we're going to call Anne-Marie out of control.
It's okay. If there was a press conference today in the East Room of the White House, she'd stand up, Mr. President, please can you comment on that Aaron Judge made the right decision? That's what she's. It would be that lame. I mean, it's embarrassing.
Anne-Marie, you are not embarrassing. You are never embarrassing. Thank you for what you do right now.
Can we get somebody that covers Washington that actually knows who the Boston Red Sox are? Is that asking too much?
Really?
Joe Matthew in Atlanta. We got to hear more from Joe. Less from Anne-Marie. It's all there is to it. Futures at -9. Stay with us. This is Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, We are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Live from New York City this morning. Good morning, good morning. 4-day losing streak on the S&P 500. Can we prevent it from becoming 5? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York City, we begin with the big issue. Wall Street execs ring the alarm. Goldman's David Solomon warning of, quote, bumpy times ahead. JP Morgan's Jamie Dimon thinks we might enter a, quote, mild to hard recession. And Morgan Stanley's Lisa Shallett says the C-suite faces a rude awakening.
A lot of corporate guidance is delusional. If the Fed pauses, which is what all the enthusiasm is about, that pricing power at best is going to have, and at worst is going to go away completely at the same time that your volumes are slowing. And it's that kind of negative operating leverage that I just don't think is in the numbers. I just think it's going to be a rude awakening.
Joining us now to discuss is PGIM's Robert Tipp and Invesco's Matt Brill. Matt, I want to come first to you. Either this economy is too hot and the Fed needs to go harder, or it's about to roll over. Which one is it?
Hey, good morning, Jonathan. I think we're in the more of it's about to roll over, but doesn't necessarily mean it has to be a disaster. You know, it certainly feels as if the best times are behind us. The Fed has pushed hard. A lot of the work they've been doing all year long still hasn't hit the market yet or hasn't hit the economy yet. So things are going to slow. That doesn't mean that it has to just completely fall apart, though. And that's what, that we have to kind of remind ourselves here, that there's still a very good foundation for this weakening to start happening here.
Robert Tipp, your take on this?
Yeah, I think that's right. I think that the surprising feature here is that rates have gone up a tremendous amount. Yes, the economy is rebalancing. Yes, there's a slowdown on the real estate side, but on balance, the numbers are really respectable. It's a moderate level of consumption. You have a rotation from goods to services. And it's not just in the U.S. You look at Australia, you look at Europe, even the UK's recent number here. You're getting upside surprises. And I think this is a different backdrop than we had even in 2018, 2019. It's a more robust underpinning coming out of the pandemic.
Can we talk about that consumption story? We caught up with Megan Green of the Kroll Institute yesterday. She wrote in the FT in this past month the following: it may be the most anticipated recession in history. She said economists have been forecasting contraction for the US economy since at least April, but a bit like Godot, it has yet to show up. Credit the cash cushion American consumers and corporations built during the pandemic. She went on to say that will eventually disappear and then the economy will nosedive. And that's what I want to focus on. We heard from Brian Moynihan of Bank of America just yesterday on this. Take a listen.
What you see in our deposit balances is year over year, they're up about 10% for, say, median income households and down. They're still up, but they're starting to deplete them. So they were at a level, they went up to peak in April after tax returns came in, and they've been flattish around, and now they're starting to go down a little bit. That's glass half full, half empty.
Matt Brill, where are you on this? Are we slowly chipping away at that cushion that has just supported this U.S. economy for the last 12 months or so?
Yeah, we've definitely seen the data out there. If you look at consumer spending, cash is being drawn down. You're also seeing credit card balances start to pick up. We saw Walmart's earnings a few weeks ago were basically stating that kind of that mid-level consumer was dropping into the lower end and shopping at Walmart. And that's not normal. So it's certainly showing a path of deterioration here. That all being said, if you continue to have a 4%-ish unemployment level, there is still cash to go around. You've seen oil come down quite a bit recently as well. That'll help at the pump and give consumers a little bit extra cash for the holiday season. So again, it's not great, but it doesn't have to be a disaster here. And we're certainly seeing signs that things are getting worse. And the Fed needs to be aware of that, because the Fed, if they continue to push for too hard for too long, this will be a back half of 2023 story, but we still don't see it happening really anytime soon.
Well, Rob, this is part of the broader conversation about just how much of earnings risk, how big that earnings risk is on the horizon. How big do you think it is?
I think it's moderate, and I think that is what skews the balance away from equities and towards bonds. Normally you'd have equity returns expected to be much higher than bonds, but bonds have really been re-rated here. And to Matt's point, the Fed is going to need to be careful not to torpedo the economy, but they know that. They have a wide range of views there. And when you think about the fact that the economy is performing at a moderate level, think about what the consumer has been through this year. We had a war breakout with uncertain consequences. We had a massive surge in energy prices. We've had a big contraction in residential construction that has subtracted a significant amount from GDP for 3 quarters. And yet, on balance, overall consumption has been positive. So they've come through a lot. I think as the Fed slows down that pace of rate hikes, there's a lot of risk out there. But basically, I think you have to watch where the errors have been. And they've been on the pessimistic side. Maybe things are not quite as bad as people think.
Can we get to that bond call? Steve Major of HSBC, a little bit earlier this morning, published his forecast. 250 for the end of 23, 2% on a 10-year for 24. And a view at the moment, you might not see it as low as 2% or 250, is that the first half for 2023 is about bonds. This was from Michael Harnett of Bank of America in the last couple of weeks. He said, like many others on Wall Street, tale of two halves in 23, long bonds the first half, long stocks the second half. Over at Wells Fargo, Eric Nelson sees a very, very different fate for yields.
It's very possible that the Fed does cut rates, maybe not necessarily next year, but in 2020, 24 and beyond. But the odds they cut rates back to zero is very low. So the floor for rates, let's say 3, 4, 5 years out, is much higher than it would have been in past cycles. Both on the real yield side and on the inflation compensation side, we look for significant upside in yields heading into next year. We think 4% will be more of a floor than a ceiling for the 10-year yield.
Let's talk about that significant upside. Robert Tipp, Eric Nelson over at Wells Fargo is talking up the potential for to hit 475 on a US 10-year in 23. Do we get closer to Steve Major's world at HSBC, Rob, or do we get closer to Wells Fargo's Eric Nelson's world?
Yeah, I'm more on the Eric's world there, because after living for 30 years on the south side of consensus, we've been in a structural bull market, and the punctuation mark, the exclamation point at the end of that came after the GFC and the Euro crisis with the below target inflation. We were locked in a world of sub 3% yields. Completely agree with that. That's where we were. Those problems post GFC, Euro crisis, those have faded. We're coming out of a pandemic. Yes, savings rates are down, but there are strong underpinnings to this economy. Central banks are primed to raise rates a significant amount from where they are. The Fed is going to end up in the 4s with some upside risk. The ECB is presumably going to top 2% easily and have upside risk. And so, there's a difference between expected and happened. And once those rate hikes have happened and the economy weathers that, then I think you're going to see a little bit of bearish sell-off. Big picture strategically, I think we're in a buy zone. But tactically, are we a bit overbought here? I'd say yes.
So overbought where on the curve, do you think, Robert?
At the back end.
At the back end on
the
10s?
Front end, 10s, 30s, yes. I mean, these long forward rates are assuming that, 2+ years from now, a 2.5% Fed funds rate is in the bag. It is going back down for sure. Hey, that's a possibility, but I think that's highly overrated. I mean, we're at record low unemployments, not just in the U.S., but around the world, in so many countries. I think the moderate economic environment of growth with low unemployment is underrated. So I think you're going to see a slow burn where the Fed gets up into that, mid-4s kind of area, and you're going to see a little bit of weakness at the back end of the curve, a little bit of stability improvement at the front end, which net is going to be good enough for a lot of the sectors of the bond market to perform well.
Matt Brill?
Yeah, so I agree with what a lot of Robert's saying there, but in general, I mean, let's sum it up with this, is that I don't think we get back to our recent highs in yields. So I think we've had a huge rally here. We're up about 8% in the investment grade index over the last, call it 10 weeks. You've had a really big move overall, and you're still down massively on the year. And we talked to so many investors back in September that said, when is the right time to buy? I want to own more. When can I get in? And we're saying, it's really hard to time this, but you probably should start entering into the market. And they just completely ignored us, didn't buy anything. Nobody bought the lows at all. And now you've seen this massive rally, and everybody says, well, if we can get back to that level, I'll buy again. And I'll tell you what I perceive this market is you never get to have that second bite at the apple. It doesn't tend to happen. And so I do think we'll hit a little bit higher here on the 10-year Treasury over the near term, but we're not going back to that 4.25. I think we're going back, maybe high 3s at some point here. But the ability to buy 6+% investment grade credit, I think that passed us, and I think people really want to get a chance at it. And I do think, to Robert's point earlier, it's definitely the year of the bond. There's a lot of reasons to be, optimistic around fixed income. And, look at the equity market. I don't know about valuations. I don't know where earnings are going, but all that is a slowdown. It's not necessarily very bad for credit. And so put it all together, I'm very positive on 2023. I think you're going to see high single-digit returns.
Matt, let's breathe some life into that conversation just a little bit more. It sounds like you think we've seen the bulk of the interest rate risk. Can you just walk me through with a little bit more detail where you are on credit risk into next year?
So I think you're kind of having the reverse of, QE. So QE forced you out the curve. It forced you out the risk spectrum. And now you're going back the other way. You don't need to take on a lot of risk in order to get 5% yielding bonds. You're seeing these withdrawals from private credit for the same reason. You can get it in liquid markets now. There's no reason to lock your money away when you can buy high-quality investment-grade bonds north of 5%. So to me, we want to be overweight investment grade. We want to be overweight double B high yield. EM, lower portion of high yield, I don't think it's necessary. It might do fine, but there's no need to reach for that right now. And I think as you continue to see the contraction and going the other way of QT, you want to stay up in quality. This is the first time in over a decade that you've been able to stay up in quality and yield north of 5%. There's a lot of uncertainty out there. I think the technicals for IG are going to be very, very good once you get over the calendar year of 2022, where investors are down, 14, 15%. And at one point, we're down over 20. So we got to change the calendar year, and then people are going to say, I really, really want to get involved here because this actually looks attractive for the first time in the last decade.
Robert Tiff, are you on the same page?
I agree that all those front-end and high-quality opportunities look attractive. I would include your AAA structured product in there as well, like your CLOs. But, we have had a big rally here. We have seen other big rallies. I mean, there was a nearly 100 basis point rally in the 10-year earlier this year after some good numbers. We had some good inflation numbers, but these, growth numbers, most recent job print, the durable goods prints, they're pretty strong. So I think, we may be going into a range. We are likely to, get to 4, above 4 again on 10s, I would guess. And there will be somewhat of another opportunity there on the long-term side as well.
Just south of 350 right now. Yields lower by 6 basis points on the day. Robert Tipp, Matt Brill sticking with us. Equity futures are negative by about 1/3 of 1% off the lows. Coming up on the program, the president says it's back.
American manufacturing is back, folks. American manufacturing is back.
That conversation up next.
about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Folks, as we see here in Phoenix, the United States is a top destination for companies across the globe looking to make investments. These are the most advanced semiconductor chips on the planet. The chips will power iPhones and MacBooks, as Tim Cook can attest. Apple had to buy all the advanced chips from overseas. Now they're going to bring more of their supply chain here home. It could be a game changer.
The President of the United States celebrating Taiwan Semi's new investment in Phoenix, Arizona. Big tech CEOs rallying behind the push to reshore manufacturing in America, including Apple's Tim Cook, building chips in the U.S. for the first time in nearly a decade.
The progress we've made with Apple Silicon has transformed our devices. Now, thanks to the hard work of so many people, these chips can be proudly stamped Made in America.
Team coverage begins right now with Bloomberg's Anne-Marie down in D.C. alongside Ed Ludlow on the West Coast. AMH, walk us through how pivotal, how significant the last 24 hours have been for this White House.
Well, incredibly significant when you have the TSMC obviously launch alongside longtime executives for the president, and this is something that this administration has really wanted to highlight in terms of a win for the economy and also national security. Also a huge win, Jonathan. Obviously, they now have 51 seats in the Senate. We can get to that later. When it comes to the TSMC event yesterday, it really highlights a shift in America. I was just looking up this recent poll that was conducted alongside Forbes, and 64% of CEOs say they want to reshore or nearshore in the near future. So what you can see is that this potentially is going to be part of a much bigger trend, and this White House really wants that stamp of approval that this is something that they were able to execute and hopefully for them have more of.
Ed, we need to talk about how important this is for Apple. You used the phrase yesterday, I repeated it this morning, de-risking the supply chain. How important is that?
It's important, but it's still distant, right? The first of the 2 Arizona plants comes online 2024. The second comes online in 2026. Go to Bloomberg.com or the Bloomberg terminal and look at the quote from President Biden in the second paragraph. These are the most advanced chips in the world. What we know is actually the chips being produced at this plant for Apple, it seems, and other chip names is 3 nanometer. Actually, in Taiwan, TSMC already has fabs and plants that are at the next generation of production technology, 2 nanometers. So actually, these aren't at the cutting edge, and it takes a long time to build factories to get them ramped up. And even at their peak, they're doing 600,000 wafers, which is what the integrated circuits are etched onto annually. Once they're at full ramp, that's 4% of what TSMC did in its full year fiscal 21. So, you know, this is an important move forward. If there's another pandemic event or another shock to the global economy, it means that Apple can sort of offset disruptions in its Asia markets. But don't forget, they're also looking at India and Vietnam broadly for this supply chain. Maybe not chips, but they are looking around now to de-risk from China.
Well, Ed, that's what I want to talk about. The elephant in the room, and you said it, it's China. 10 new rules for the path to reopening in China announced a little bit earlier this morning. Does that make a big difference for this company?
It's not helping the stock, in pre-market. I think we're still down 0.8%, which I think we'll come into in a second. The disruption at Foxconn is complicated, right? It was partly due to strict COVID protocols, testing, and also sort of containment practices. That led to protests, and the protests among the workforce disrupted production. The problem is, as we've been talking about, John, that production is concentrated within a facility, one facility in one city, Zhengzhou, otherwise known as iPhone City. There is a lot of optimism, though, if you don't just look at Apple, but also the US-listed shares of China Tech, that these measures actually will see the consumer at least come out, which will help the demand side of the equation. And yes, it will allow companies like Foxconn to operate their factories more freely, which will improve the supply side of the situation.
Apple down about 0.8% of the pre-market. We're going to talk about the demand side of the equation in just a moment around the opening bow with that. I just wanted to squeeze this in with you, AMH. President Xi, where President Xi is today in Riyadh. And this was from one Saudi commentator who said the following: this visit is the culmination or crowning of a deep strengthening in relations over the last few years. The US is concerned about this, but cannot slow this already strong relationship down. AMH, how is this playing out in Washington?
Well, what a welcome Xi Jinping has received, Jonathan, by the way, in Riyadh. If you look at the pictures released from the Saudi state news agency, it's red carpet and all. The president said it, you don't even have to talk about them today about it. The president said it over the summer. He does not want a vacuum in the Middle East, which is why he attended this Arab summit in Jeddah, and he doesn't want a vacuum for China or Russia to fill. Well, it does look like China is clearly trying to make inroads on that vacuum, which is what you hear from Ali Shahibi. Basically, China wants to make sure they are not just shoring up their energy supplies for the future, but they're also looking at other avenues where they can collaborate with Saudi Arabia. And the timing is difficult for the administration because not this last OPEC meeting where they rolled over, but the previous one where the group decided to cut 2 million barrels a day. That obviously sent shockwaves through Washington, and the relationship was, quote, under review until then.
And look at crude now. We'll touch on that around the open. Ed, I'm going to catch up with you on Apple in about 8 minutes' time. Looking forward to it. Equity futures right now, negative 0.25%. Our special thanks to Anne-Marie as well. As always, we need to talk about China reopening. We spoke to Krishna Mamani a little bit earlier this week of Lafayette College. Take a listen to what he had to say.
This is a very positive development, but at the same time, full of all sorts of risks for the global markets. There's a substantial risk that things actually get far worse from a COVID standpoint and a production standpoint, and we revisit the supply chain issues that we had a few quarters ago.
Robert Tipp, Matt Brill, back with us for a final word. Matt, is it a good thing or a bad thing that China's reopening in the way it is?
I think it's a good thing. It's probably not enough yet, but I think it's on the right path. And the U.S. needs China to be open. The global economy needs China to be open. And, we go back to this low inflation for so long. A lot of it's been driven by globalization. And as the last conversation about investing in the U.S. is deglobalization, and that's more expensive. It's good for the American economy. It's good for the American worker, but it's not good for inflation. And at some point, you need to have some balance here of going back to having some globalization pick up. And be able to be importing deflation into the United States. And we're not at that point right now because of some of China's issues.
Robert Tipp, which one is it, good or bad?
Yeah, I would say a couple things on that. I think that China has remained, in some respects, insulated but active. Their level of imports and exports has been spectacular through this. So that would be my wager, is that it's going to be less of an impact than we think on the rest of the world. On that manufacturing and cost point, manufacturing up until COVID had been losing a steady pace of employment. And since then has been averaging, if we were in a normal world of 150,000 jobs a month, 6 months ago, it was running about 45,000, about 30% of a normal rate of total job creation would have been coming from manufacturing. And that's only down to 20% right now. Manufacturing is probably less than 10% of the economy. So that notion of past peak globalization, it does create jobs. It also creates a little bit more inflation. I think that's what's kind of going to be the difference in the post-pandemic environment. A little bit more resilient growth, a little bit higher inflation, steady state of higher interest rates than we're used to, but also steady state higher fixed income returns.
And maybe Fed funds just a little stickier than some people think.
Oh yeah.
Robert Tipp, Matt Brill, to the both of you. Wonderful as always. Equities right now down 0.2% on the S&P 500. In the bond market, we do have a bit. Treasuries rallying. Yields lower by 7 basis points. 346 on a 10-year, on a 2-year, 429. Coming up, the bumpy road to nowhere. Why Bank of America's Savita Subramaniam thinks stocks end 2023 almost exactly where they are right now.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Minutes away from the opening bell, equities down just 1/3% on the S&P, on the Nasdaq down 0.5%. That's the price action. Let's get you some morning calls. JP Morgan downgrading Lionsgate to underweight from overweight, growing increasingly concerned about the company's leverage and weakening demand. Your second call from Wedbush downgrading Carvana to underperform, saying recent developments suggest a greater probability of debt restructuring. And finally, Wolf Research downgrading TripAdvisor to underperform, expecting the macroeconomic slowdown to weigh on travel demand next year. That stock is down by more than 4%. Coming up, gearing up for a challenging 2023. Bank of America's Savita Subramaniam expecting a volatile year ahead to leave stocks almost exactly where they started the year. This is Bloomberg.
Satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
22 seconds away from the opening bow this morning. Good morning. 4-day losing streak on the S&P could become 5. Equity futures down 0.25% on the S&P. On the Nasdaq, we're negative 0.5%. On the Russell, the small caps lower by 0.25%. Just a little bit softer going into the open. There's the opening bow. Switch on the board and get to the bond market. Yields are lower, much lower in the last hour or so. Down 6 basis points on a 10-year, 347. How about that range? HSBC looking for 250 next year on 10s. Wells Fargo says we might push 475. Pick your poison. In the FX market, euro dollar 105.23. Interested to see equities lower, bonds bid, and then see the dollar weaker. Euro dollar 105.22. Euro dollar positive 0.5%. If you see stocks down, typically you might expect to see yields up and the dollar stronger. Not seeing that today. Crude up 0.4%, $74.60. And I have to say, the headline of the last, month, the fact that crude yesterday closed lower for the year is just absolutely staggering. Unbelievable, given the 12 months that we've seen, and we'll talk about that in just a moment. Around the open, then, about 45 seconds in, the S&P 500 shaping up as follows. We are lower by just 0.2%. On the Nasdaq, we're down about 1/3%. One stock to watch at the open is Apple, a key supplier expecting the company to reduce iPhone 14 production even further. Murata Manufacturing seeing demand dropping in the coming months, saying, quote, "I hope that it won't be too deep." Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. We're down. We're flat on Apple, down just 0.1%. If we do close lower, it would be the 5th straight day of losses for Apple, its worst run in a month. What Norio Nakajima, the CEO of Murata, said, and he did not name Apple. He didn't explicitly name Apple, standard practice for Apple suppliers, but he referenced their biggest and their US-based customer, which is, it's Apple, John, that he is looking at the handset availability in stores of various markets, and particularly the iPhone 14, not the higher-end Pro model or Pro Max, just the iPhone 14. Based on the availability of that model, he thinks that actually the demand isn't there, and that is the basis for the expectation that they'll see a revision downwards, a further revision downwards for Apple. Remember, Apple no longer publishes a firm guide or a running total of production, but Bloomberg's already guided that that initial target of 90 million units was cut back to 87 million anyway for this final period of the year because of a slump in demand on that lower-end handset anyway. So we are just a little softer, basically flat on Apple, not as sort of severe as it was in pre-market. But it's interesting because this has been a story that's gone and gone and gone. It is the lower end of the market that's the problem, not necessarily the high end. And interestingly, John, it's the high end of the market in the pros where we saw the production disruption in Zhengzhou, iPhone City in China.
And it's a $2 trillion mystery, isn't it? Is it demand or supply? What's the big problem over there?
I mean, I think it is both. You know, this is the irony of the situation. There is demand for the higher-end handset, and we look at wait times for delivery, particularly in North America, the United States. Those have started to improve, and that was a basis of interest for a number of sell-siders, for example, UPS, this week. Earlier in the month, if you've gone onto apple.com and tried to get yourself an iPhone 14 Pro, you wouldn't get it until after Christmas or even after New Year. That situation's improving. That's the model that's in demand. The lower end model is not, which is consistent with what we see across consumer electronics. That at the lower end, for that broad portion of the market, that's where the demand has dropped off, and the supply is fine.
Stock's down just a third of 1%. Ed, great work. Looking forward to your coverage a little bit later. Ed Ludlow there. One more name if you want some earnings. Campbell Soup, the CEO, highlighting a strengthening supply chain, writing, quote, "We're raising our full-year fiscal 23 guidance while taking into account the volatile economic environment." Abby, they're topping estimates.
Yeah, they certainly are. They put up a great quarter. And so here you have another consumer staples company that's really able to weather this difficult environment, this inflationary environment relative to the quarter that just was. They beat double digits on adjusted earnings. They beat by 5% on sales. They raised the outlook. But similar to PepsiCo, it's very interesting. This isn't because of just the strength of the business. In fact, volumes down, but they're able to pass along the cost of the customers. And that CEO, Mark Klaus, also talking about that they're able to pass along the higher prices and certain productivity changes. Now, this could be one reason on the year why Campbell Soup, it's amazing. This stock is up sharply on the year, up more than 20%. The food index is also higher, really outperforming the broader market, the S&P 500. And what's so interesting, and maybe even surprising to me, John, at this point, eating at home is far more expensive than eating out at a restaurant. The growth over the last couple of years since the pandemic, double digits, 22% for eating at home relative to restaurants. Now, this company, it has something also helping it out, John. It's not just soup. There's a wide variety of products, a few that I like, including Goldfish and some of their chips. I'm betting that maybe you with your sweet tooth, Pepperidge Farm cookies.
Is that the recommendation?
It could be. The shortbread, pretty good.
Appreciate it. Avi, thank you. That stock is up by more than 4%. Looking at the market right now, basically unchanged on the S&P, the Nasdaq down by almost a tenth of 1%. You know the year ahead outlooks, don't you? Investors seeing a challenging year ahead, making the case for defensives.
We are still quite defensive.
Really focusing on more defensive positioning.
Thinking about ways to keep exposure, but with a slightly more defensive tilt.
Which means staples, healthcare, non-energy utes.
Healthcare really exemplifies a resilient sector.
Healthcare and that part of the market makes a great deal of sense to me.
When it comes to recessions, healthcare is resilient.
Tony was making a really good point.
You kind of have the trifecta: better long-term prospects, good and slightly better recessionary prospects, and better valuations.
High-quality defensive stocks can actually, do pretty well in this environment.
That's the outlook. You know it well. On the S&P 500, where we are right now, about 4K, is where Bank of America sees 23 ending. Savita Subramaniam expecting a bumpy path to nowhere and writing the following. The S&P 500 year-end 23 target, 4,000 on 200 EPS. Near-term pain for EPS cuts is likely, but focus on the marathon. We see a potential bottom in the first half. 22 is all about the Fed. 23 is all about the economy. Savita, I'm pleased to say, joins us right now. Savita, is that how you describe it? A bumpy road to nowhere?
Well, I mean, I think the probability of ending the year at exactly 4,000 is low, and point-in-time targets are somewhat ridiculous, but I do think that we are going to go down and then up. The problem is that is an increasingly consensus view, so I think the bigger risk heading into the first half is actually not being invested in equities. I actually think that having a little bit of a cyclical tilt makes sense at this point, because I think the market is looking through the most widely telegraphed recession ever. I think that having some exposure to CapEx plays, to cyclicals in the form of energy, financials, to me makes a lot of sense, because I don't see demand for energy going away, and I don't see supply coming back online aggressively. Financials could benefit from, a kind of a recession. It could do better in a recession because it's a higher quality sector, but could actually benefit from easing credit conditions. I think we need to look at the market differently. We need to look at this recession differently. This is not the typical recession. In fact, a whole section in our year ahead report was dedicated to the idea that this is not your mom and dad's recession. This is going to be different. And the reason it's going to be different is that we've still got inflation. We've got a Fed that is fighting inflation more aggressively than they have needed to in a very long time. None of us in our careers have seen this type of Fed. We've got a consumer that has made a ton of money from asset inflation, especially on the high end. And now the high income group is getting laid off and losing asset value. So I think this recession is going to be different, and I think that's what we need to pay attention to.
Savita, if I clip the first part of those comments, there's no way I'd think you'd have a year-end forecast of 4,000. You sounded almost bullish. Are you de-emphasizing the importance of the index and selectively taking cyclical risk beneath the index and just removing tech from the story?
Absolutely. I mean, one of our themes for the year is don't index, outdex. Kick out the biggest mega cap stocks because they're still in the process of re-rating, and even though they look cheap, we think they're value traps. Buy the rest of the S&P, buy small caps, buy the equal weighted S&P. But I think that not having exposure to stocks and sticking all your money in bonds and cash is a mistake at this point. I mean, a lot of our sentiment indicators are telling us that the world is bearish, and you just heard it from all the other strategists. Be defensive, bunker down, get into healthcare. I think what you want to do right now is think about both the long term and the short term. In the short term, the Fed is probably going to be forced to hike more than we're expecting. I think inflation is going to remain upward sticky because of CapEx trends, because of deglobalization, because of protectionism, because of net zero trends. All of the above contribute to inflation. Plus, the second largest economy in the world is coming back online. Isn't that a little bit inflationary? So I think the idea is think about the long game, but don't sell everything. I don't think this is the time to be out of equities.
So underweight tech, I'm reading the note, cyclicality and deglobalization risk. We'll come back to that last point in just a moment. Where does energy fit in? On the year, crude is negative on the year, as of yesterday at the close. Energy equities are up more than 50%. Do you stay with those names going into next year?
Stick with it. I mean, the world is still underweight energy, and one of the reasons is it's hard to own energy if you're, kind of a, making nice with ESG and focused investors. So fossil fuels have been anathema for investors. We're still tracking a pretty significant underweight in U.S. energy for the average long-only or hedge fund investor. Our view is it's starting to hurt being underweight energy. It's a big enough part of the benchmark. And when you listen to Francisco Blanch, our commodity strategist, he thinks that oil could hit 150 next year. I mean, I think this is an environment where you don't want to be out of energy, and in fact, you want to be overweight energy. We've been waiting to downgrade energy when everybody is overweight, and we still haven't seen that level of exposure. I think that also the important thing to realize is that energy companies are not going to flood the market with supply like they usually do when oil prices rise. They've been smacked down by their investors so many times that they're now more focused on meeting their emission reduction targets than meeting production goals. And I think this is a really interesting setup because, eventually oil is going to fall to close to zero as we move to this clean, green net zero world. But we are nowhere near that point. And along the way, this CapEx boom, even green CapEx, is going to benefit traditional sources of energy. That's our view.
Just the final word on tech. When it came to tech, the underweight was off the back of what you say is cyclicality and deglobalization risk. What is the cyclical risk that you like in energy that you do not like in tech?
Well, look, I think that for tech, we've seen a massive demand pull forward during COVID. So all of the CapEx that you saw for the last 3 years has been focused on tech spend, focused on software. Tech has been it in terms of drawing CapEx. Now we're in a different environment. Tech companies have excess capacity. They're firing people. I mean, they're going to get better, but I think where we're seeing the tight capacity is in energy. I mean, energy companies, if you look at, we have a chart that just shows the supply response of energy companies. We're seeing nothing in terms of excess supply being added to the market. So I think that's the area you want to focus on, where tech has seen demand pull forward. It's susceptible to corporate spending cuts. It's susceptible to consumer spending cuts. If you think about high-income consumers that spend a lot on tech and gadgets, these guys are losing their jobs, and they've seen their wealth destroyed. I mean, I think it's a sector that is fraught with cyclical risk. And oh, by the way, information technology is more correlated with the ISM than any other sector in the market.
Savita, I could talk to you all day. If you came on more often, we could talk for a whole lot longer. And that was a dig. I want you back more often. Savita, just a final word. Lessons from 2022 for you and the team. What are they looking ahead to 2023?
You know, I think lessons from 2022 are that cycles take a lot longer to play through than everybody expects. And I was expecting to end the year with the world overweight energy and inflation plays and underweight tech because of the performance we've seen. But I think the lesson is that investors have muscle memory of making money in tech stocks for 10 plus years. And that needs to go away. We need a full washout, and we haven't seen that yet.
Savita, wonderful. Let's catch up soon. Savita Subramaniam there of Bank of America. Your equity market right now, almost unchanged on the S&P, up about 0.1% on the NASDAQ, down about 0.1. Coming up on this program, austerity creeping up on Wall Street's biggest banks.
2021 was an exceptional year. 2022 was a different year, and so naturally, compensation will be lower.
That conversation up next.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest revenue year ever for the firm. 2022 was a different year, and so naturally, compensation will be lower.
Austerity coming to Wall Street. Goldman's David Solomon warning of compensation cuts. Bank of America cutting back on hiring.
In the early months this year, we were hiring 4,000 people. We were hiring 2,000 against 4,000 leaving. Now we're hiring, then we got to hiring 4,000 against 3,000 leaving, and now it's down to 2,000, so we had to slow down the hire. We seek talent all the time. We bring them in the company. We're just more careful about it in times like this.
Morgan Stanley might be taking it a step further. The bank's set to cut its workforce by 2%. Team coverage starts right now with Sonali Basak and Michael McKee. Sonali, first to you. Fantastic job in the last 24 hours. This feels incremental to us.
Yeah,
Where's it going?
Well, it is incremental if you think about it. What's interesting about this is if you look back to 2019 when Morgan Stanley cut jobs to prepare for tougher times, it was also 2%. Back then, the headcount was 60,000 or so. Now it's more than 80,000. So if you think about over the last couple of years just how much these firms have grown, they're still just cutting what they did pre-pandemic, which means this is not panic mode, John. This is the culling that you would see prior to a hard time, after a boom time. And by the way, over the last several years, we've had a lot of boom times for these investment banking and trading desks. And after a very tough year, could have been worse. It never feels good to have job cuts. But again, this is very typical behavior of the banks. I would say in addition to these cuts, John, you're also seeing a lot of early retirements, a lot of questions about the variability of the highest ends of the pay scale here when it comes to the large banks, especially after the younger ends of the pay scale had just asked for all of those raises and had moved their fixed compensation a little bit higher. Remember, a lot of these firms are also seeing chances to hire. Tech firms have been firing people. They have been laying people off. You also have, on the other end of things here, all those crypto firms have been falling apart, which means the people who have moved for these kind of high-risk businesses don't have those options once again. So again, that gives those employers a lot of leverage here, and you do see them hiring, but you do see them starting to scale back their workforces a little bit to start to reposition for a new competitive set ahead.
Mike McKee, we've seen it in tech, starting to see it just slowly in the financials. Is something building for you?
No, not yet. And here's why. You take a look at what's happened in previous years. Sonali hit the nail on the head. This is a very cyclical business, Wall Street. And whenever we start to see the economy slow down, you start to see hiring slow down. And you look there, the white lines are deal flow in the investment banking business, and you can see how much it's fallen off. Now, the thing is, if you look far to the right there, you still have a question about what's going to happen to hiring and overall staffing levels. Yes, they're starting to cut back, but nothing like they did in the past. And that's in part, I think, because there's real confusion, real uncertainty about what's going to happen to the economy next. The overall forecast for unemployment at the end of next year, according to economists surveyed by Bloomberg, still 4.5%. That's hardly anything compared to where we have been in the past during recessions. So do we see that go much higher? Do things slow down much more? That's what they got to figure out. Sonali mentioned tech jobs, and I'll just wrap up here by noting this. I was going to show you the number of financial services jobs in relation to total private jobs, which is the white there, and it doesn't even show up. It's so small. Red is the tech jobs. That's how many tech jobs there are compared to all private sector jobs. And so, as you can see, these two sectors are not going to have a major impact on the economy. That said, I think we have to put the caveat in there that all three of us would probably take what an investment banker makes in a bad year if they offered it to us.
And I think a lot of people at home might agree with that. Can we all agree on this? Sonali, are the days of the first-year analyst at Goldman doing a PowerPoint presentation with a list of demands for the C-suite, are they over?
Oh, they are surely over, because you know what? There's a pipeline of people in business school right now that are very worried about their jobs ahead. I hear it every time I walk into a bank as they go into business school. So there is somebody else in line to take their job.
I imagine there's some people at the bank, many people at the bank, that might be happy about those days being over. Sonali Basak, thank you, alongside Mike McKee. Sonali, again, wonderful work in the last day or so. Your equity market, about 22 minutes into the session, looks like this, down 0.2% on the S&P. On the Nasdaq, we're down about 0.5%. I've talked a lot about that move in the bond market over the last couple of hours. Just a bit. Firmer Treasury market coming in. Yields lower now by almost 7 basis points on a 10-year to 3.46. On a 2-year, we're down 8 basis points on a 2-year to 4.28. You can call it 4.29. Let's get you some sector price action in the equity market. Here's Abby.
So, John, that decline that you were just talking about for the S&P 500 represents the 5th down day in a row, the longest losing streak since October 12th, so almost 2 months. But interestingly, we have more sectors higher than not, which may suggest that perhaps we're going to see a reversal as the day goes on. Up top, real estate, and we'll be talking about that a bit more in just one moment. Why we have stocks down, or the majors down, we have consumer discretionary, services, and tech on bottom, those mega cap techs, those big weightings. But there's one sector, one stock that I really want to talk about. I think it's important we talk about it, which is the home building sector, the housing sector. Toll, they put up a great quarter, beating in a huge way, but it's the commentary that's coming out of that call, which is so interesting. They're saying that if the mortgage rate goes below 6%, things will get better. Mortgage rates today did fall for a fourth week. Now it's 6.4%. They're also talking about the fact that 20% paid in cash. The average down payment was 29%. This is the luxury segment, so it's the high end. New York City, the best. So all of this goodness may be signs of hope for housing, but down 35% on the year.
Abby, thank you. Your equity market lower too, down 0.4 on the S&P, on the Nasdaq down 0.75%. Coming up, your trading diary from New York. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Five minutes into the session, equities lower by a third of 1% on the S&P. Tech is where the underperformance is. Bank of America's Savita Subramaniam on with us about 20 minutes ago, talking up, or rather talking down technology. Very underweight going into 23. Equities on the Nasdaq down about 0.75%, echoing that kind of story. In the bond market, yields look like this on 2s, 10s and 30s. Yields are lower at the front end by almost 8 basis points now. Your 2-year 428.93, your 10-year down 6 basis points. Let's call it 347. That's the price action. Here's the trading diary. The White House press secretary holding a news conference at 2 Eastern. China's President Xi in Riyadh for a summit with Saudi leaders starting today. ECB President Lagarde speaking on Thursday, followed by another round of jobless claims in the United States tomorrow morning. And finally, US PPI and the UMich Consumer Sentiment Survey to close out the week on Friday. From New York City, that closes out the show for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I'm interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering